Well, good morning. Well, in some cases, or I guess in all cases now, good afternoon and happy Veterans Day. Thanks to those who have served and continue to serve our country. And welcome to the second day of NAIFA's inaugural event, Impact Week, Long-Term Care. I hope you were here yesterday because I have to tell you, it was terrific, really terrific. And a recording will be available to those who had registered. And today, this promises to be another really outstanding day with the objective, of course, of being to broaden our options, broaden the way we talk about long-term care, because as everyone knows, for a while, we didn't get really great press. So what we need to do is really broaden the way that we consider options so that as clients start to tell us their story, for example, we'll be able to be a more active listener and relate in some way to what they are telling us and have all these different options in our minds. I'm Carol Golden, the Executive Director of NAIFA's Limited and Extended Care Planning Center, or LECP for short. And before we get into our program, I'd like to thank our limited and extended care planning sponsors for funding and supporting this event. The Intercompany Long-Term Care Conference, ILTCI. One America, Certified in Long-Term Care, CLTC. Life and Annuity Certified Professional, LACP. Mutual of Omaha Mortgage, Advanced Resource Marketing, ILTCI Partners, Senior Marketing Specialists, Legacy Shield, Genworth, and Penny Insurance. Thank you. You know, for so many years, with that public perception being that we only had one product or one way to approach extended and long-term care, well, happily, our industry is expanding. And for that reason, this 3-day Impact Week long-term care is for us to be able to really enhance the broad spectrum that we can offer our clients. So before we start, though, I do have to go through a few housekeeping rules. Not a surprise, right? So of course your microphones are turned off and your cameras are turned off. Well, I guess your microphones are actually muted. Anyway, also, if you have a question for the presenter, please put it in the chat function and a NAIFA member is going to monitor them. If for some reason we don't have time to get to your question, you will be contacted directly. And because I know you're anxious to hear from our presenters, I'm not going to read anyone's bio, but if you would like to look at their biographies, they are available at the registration site, lecp.naifa.org/impact. So let's start right into day 2. I'm very pleased to introduce our first session, LTC Insurance 2.0. Steve Kane, Sales and Business Development Leader at ILTCI Partners, is our moderator. Our panelists are Ryan Bivens, National Sales Manager, Long-Term Care, Pacific Life. Tracy Edgar, excuse me, Vice President of Sales, Care Solutions, One America. Brandon Hessett, National Sales Vice President, Secure Care, Securian Financial, and Tony Massanelli, Director, LTC Sales, Nationwide. Thank you, gentlemen, for joining us. Steve?
Hey, thanks, Carol. And again, I want to thank everybody for taking the time this afternoon to talk about LTC 2.0. I consider the folks that we have on the line with us not only partners in this business, but they're friends too. And we're going to have a candid conversation about long-term care planning today and in the future. But, you know, Carol mentioned we're going to keep it brief on introductions because we wanted the speakers to talk a little bit about themselves. So I'm going to start with Ryan Bivens from Pack Life. Tell us a little bit about yourself, how you got into the business, what you do over there at Pack Life. And I'm going to ask everybody an interesting one. Tell us something we don't know about you.
Hi, Steve. Thank you very much. Good afternoon, everyone. It's great to be with you. I'm the National Sales Manager here at Pack Life for our sales and distribution for our Premier Care, our asset-based long-term care products. I started in the industry probably about 14 years ago. Spent a couple years as a financial advisor. Then I got into wholesaling a few years after that, and have been here at Pacific Life since about January of 2012. Long-term care became an interest to me. My grandfather came down and developed Alzheimer's many years ago. Didn't have a plan in place whatsoever for him. And it wasn't so much that I was looking to get into long-term care, but that definitely had an impact because I saw the burden, family expenses, et cetera. But when the opportunity for wholesaling came about in November of 2008, I jumped at the opportunity at a long-term care wholesale with another carrier. So that was a great opportunity to get in, and obviously have been at it since then and truly enjoyed this space. Steve, it's funny you were mentioning earlier before we were prepping for this meeting about height, right? Kind of being a little bit vertically challenged. Steve and I are about the same height. Obviously, you can't tell based on camera, but you probably didn't know, Steve, by looking at me, that I was able to dunk a basketball in high school, starting as a sophomore year, all the way up until about 3 or 4 years ago when I messed up my ankle on a Spartan race. So that's a little bit of fact for you.
Wow,
there you go.
Leapers. All right. Tracy, tell us a little bit about you.
Hey, hi, Tracy Edgar, Vice President of Sales at One America, and been in the long-term care space for, 21 years almost now. So a long time. So a lot of familiar names I saw popping into this call, and it's good to see you again, Steve. I think I was going to pick out, I have a couple of quirky little things about me. So most people don't know that I was actually born in Honolulu, Hawaii.
Right.
People may not know that I'm also a veteran of the United States Army.
Thank you.
You're welcome. I was a master fitness trainer and a helicopter mechanic, which is an interesting background for somebody who's now in the financial services industry. And the last thing I would share with you is I have a complete and utter weakness for good brownies. Like I'll eat the whole pan.
That's great.
There you go. There's a little
I love it. Hesketh, that's going to be tough to follow.
That's a tough one.
Let's hear it.
Good afternoon, everybody. My name is Brandon Hesketh. I'm the National Sales Vice President at Securian, responsible for our distribution strategy and the product strategy for our Secure Care asset-based long-term care product. So glad to be with everybody today. I've been with Securian for the past 4 years, and I've been in the LTC space for coming up on 20 years. Started my career in 2002 at GE. As far as something that people probably don't know about me, it's an interesting fact that I'm an avid NASCAR fan. So I know that's a little random, but just coming off the end of the season here this past weekend, that is something that I still follow dearly. So probably not
cool.
will know that about me. So happy
Very
to be
cool.
today.
And Tony, I know I can say for certain that Tony cannot dunk or could never dunk. Right? Tony, tell us about you and Nationwide.
Yeah, well, I think I share Ryan and your vertically challengedness, but you're right. I never could dunk a basketball. My name's Tony Massinelli. I've got responsibility for sales and distribution here at Nationwide for our Care Matters linked benefit product. Been in the industry for 20 years now. I also started as an advisor, and one of the first sales I ever had as an advisor was a traditional LTC policy. I can't say that's really what got me into this business, but I've been 18 years now at Nationwide. When Nationwide really made a decision to enter into this space, we back in 2011 we started building our Care Matters product. I jumped at the opportunity to do something different. I had always been in the life insurance side of the business, and I said, you know what, this is a space where I've had family members that were impacted, as all of us have, I'm sure, or friends. And this is an area where I felt like Nationwide could grow, and that's really what sparked my interest here, and got me into this space. And then to tell you something just a little different about me, prior to marriage, prior to kids, a few buddies of mine and we took a trip to Spain, and I can say that I have ran with the bulls and that the bulls did not get me, or a bull did not get me. So it was an interesting experience. I'm glad I did it. I can't say I would do it today, but I'm glad I did it, 15 years ago.
That's great. That's great. Thanks, Tony. And, again, we got a pretty aggressive agenda for this afternoon in terms of things to cover. Here they are. And again, we're going to go back and forth as a panel.
Where was the volume thing?
So we're going to talk about capitalizing on LTC Awareness Month. For those of you who don't know, this is November, and this is our version of a Got Milk campaign. So this is LTC Awareness Month. We're going to talk about resources that are available to advisors out there. We'll go over industry trends and give you a marketplace update. If there is no buzzword, it's best interest, or if there isn't one that's bigger, it's best interest, suitability, fiduciary duty. And we're going to talk about how does that fit into these hybrid or combination products. We're also going to talk about marketing, right? These are fantastic products that are leading the charge in our industry today. How are we marketing these? How are we educating advisors and consumers about these products? We're going to talk about underwriting, what's going on today and then tomorrow. And then we want to make sure that you're left with best practices, something that you can use today if you're talking to a client about these types of products. And I promise you, after talking to our panelists, that they're going to give you tactical tools, concrete talking points so that you can go out there and use it. And we want to talk about 2021. What are some of their bold predictions? So that's the agenda. As it relates to LTC Awareness Month, certainly go out to the NAIFA LECP site. We've got all kinds of information out there for you. But let's just talk carrier resources for a second. Tracy, I'll start with you. What has One America done in terms of resources for advisors for LTC Awareness Month?
So LTC Awareness Month, I think what we really focused in on this time is just around this whole speaker series. So, what we are starting to feel like is that advisors are really feeling like they're getting so much information coming at them and just wanting them to be able to have something else to draw from. So the speaker series is not product specific. It does have a lot to do with financial planning and resources, and it has a lot to do with long-term care. But what we're really trying to do is to try to help advisors really grow their business over the course of the Long-Term Care Awareness Month. So we still have a handful of speakers left, and if you're interested, you can certainly go to the One America website, and that will show you when all of the speakers are scheduled.
Tracy, sometimes it's not about product always, right?
Right.
And I've really enjoyed the series because it hasn't been a deep dive into product, which we can all do, and you've got those resources too. But I picked up a lot from some of those speakers. Brandon, what have you guys been doing?
Yeah, Steve. So much like Tracy said, this is the most important month of the year for the LTC space. So we're doing a month-long webinar series. So every Tuesday at 2:00 Eastern, we're doing a webinar series. So we've done 2 of them already. We have 2 more scheduled. You can find information about them on our website. And then the other piece that we're doing, we've launched 12 social media posts that are consumer approved. And so they're not specific to the Secure Care product or Securian. They're more focused on the need for LTC planning and having that conversation. So those are really 2 of the key things that we're doing throughout the month of November.
That's great. We're going to touch on that in marketing because I think that's what I'm hearing from a lot of advisors is they want consumer-friendly pieces, stuff that's ready to roll, that doesn't specifically dive into a product. So that's helpful. Ryan, what about you at Pac Life?
We've definitely focused on helping advisors engage with clients around long-term care planning and conversation. We sort of have a speaker series, but it's much more on the regional, local level. We actually launched it a few months ago, kind of in preparation and leading into Long-Term Care Awareness Month. But it's usually hosted by one of our wholesalers. They help an advisor identify clients within their book of business that think would be a good fit for the long-term care conversation. We do the webinar with the client and the clients and the advisor, and through that presentation, we're always pushing the client back to the advisor to have a conversation around long-term care. It really helps the advisor be more effective in that conversation because we know that many times these financial planners, asset managers struggle with initiating a long-term care conversation. So it's our job, our goal to help them with that And if we're the right fit for product, great. If we're not, there's obviously other solutions out there that might be right for that particular client.
That's great, because what we've been seeing is that people get it nowadays. People that we all have some kind of connection to somebody that's needed long-term care, but starting that conversation has become the toughest part for many. So Tony, what have you done at Nationwide to help us with those conversations?
Yeah, we've taken a very similar approach to what everyone else mentioned. We have our standard kind of LTC Awareness Month kit of marketing pieces that we have put together. We have had some virtual presentations that our industry expert Sean Britt has done in multiple situations. We've partnered, similar to what Ryan said, around helping advisors having the conversation and broach the topic of LTC. One thing maybe a little different is we've taken an approach around a 3-part series that we've offered up to a lot of different organizations out in the industry around LTC in uncertain times, LTC during this current COVID environment. And then we have a heavy focus right now on LTC tax strategies.
That's great. That's great. So again, start with the NAIFA LECP site, and then you've got our carrier partners that have all kinds of information that they shared. Additional resources, there's National Association of Health Underwriters has a long-term care portal. Certainly Life Happens, which many of us support, has some great consumer-facing content. CLTC, which was one of the LECP sponsors, has some great content. I just went out on longtermcare.gov yesterday to see if they've got good content, and they do. It's up to date. And then many of you partner with either a long-term care specialist or a brokerage operation that can support you as well. Last thing I do, just as a practice, is I type in Google News searches, right? And what does this do? This pulls from thousands of publications, and you put in your search terms, whatever they may be: long-term care, LTC insurance, caregiving, protecting your 401k, and it'll pull up those keywords from thousands of publications. So that's another way to kind of keep your thumb on the pulse of what's going on and share information with your clients. All right, so let's flip it over to the marketplace update. I know that we've seen in our business just a heightened consumer awareness around long-term care planning. I think more than any other time in my 20-year career have I seen people more freaked out about their health, right? Those are very technical words, by the way, jargon. People are just concerned. Like, am I going to get this thing? Is it going to impact me now? Is it going to impact me long-term? And you combine that with an aging population and with folks like me dealing with my 80-year-old mom or others like you dealing with loved ones. And so I think consumer awareness about long-term care planning is at an all-time high. And so what we have to figure out is, how do we convert that awareness into people taking action? And so I wanted to give a brief marketplace update. Tracy, you've seen maybe an 800-pound gorilla in this industry kind of lead the charge. And then over time, your company and your efforts have really carved out some market share, and you're seeing more and more. What are you seeing in terms of products coming into the marketplace?
Yeah, so we've heard some rumors about new entrants in the marketplace, and some of them we've been able to substantiate. Some of them we've been able to substantiate that they are not entering the marketplace. I think people, generally speaking, carriers are interested in this product. If it's done properly, it can be a profitable piece of a carrier's overall business. But there are a lot of risks associated with it, and companies who are not familiar with how to underwrite from a long-term care perspective, or to how to take the morbidity and mortality and sort of link those two things together to come up with pricing. I think as we continue to see this prolonged low interest rate environment, just puts a lot of pressure on product pricing, and we've seen that happen over the last year, where we've seen some companies with multiple rate increases, some companies with single rate increases, just trying to keep us all or get us all back sort of on a level playing field from a pricing perspective. But so that's what I think will continue to happen is as this prolonged interest rate stays low, I think we're going to see, some of the carriers that are even on this call today, I would anticipate are probably feeling a little more pressure than some of the other ones that are on this call today, just with the environment that we're in.
Yeah, we're seeing, conversations about more companies coming in. But again, I think you're right. We're all challenged by this low interest rate environment. And I think as things go up and they begin to normalize, we'll see more. Brandon, you've got a newer product that's on the streets compared to your peers. And you've also got life insurance products that have chronic illness and accelerated death benefit options. Is there a directive like we want 50% this business, 50% the other? How does it work within your own company?
Yeah, good question. So we've really been focused on having that full suite of offerings. In fact, that was what the first webinar this month was around, was the suite of offerings that we have on the permanent life products, our term life products, and then certainly we have the standalone secure care solution. So really by design, we know that there's different products for different consumers. And so really that's been the focus with having that robust portfolio, is to have a solution for many needs. And so there is not a company directive of we need to sell X% of this product versus the other one. And we rarely see them competing against each other. Like I said, it really comes down to the consumer value and what they're looking for with solving that need for long-term care coverage.
Yeah, I want to cover that a little bit later in terms of suitability, because we get the question all the time, what's the best fit? Where should I use this product versus that product? And I want to cover that in a bit. Underwriting changes. We've seen a number of carriers make some changes during COVID-19 and then changed it again during COVID-19. So Tony, what did you guys do any changes? And if so, why?
That's a good question. We haven't made any changes from an underwriting perspective on our life or our Care Matters offering. And that was really a company decision that we felt comfortable with the risk and where we were accepting that risk, both on the life and the Care Matters and LTC Care Matters side of the house. Now we've made improvements to our process through this COVID time as far as how we accept business, and even our electronic process along the way. But the great thing from a LTC standpoint is all of the underwriting has been done behind the scenes. So we're not, and I don't think any of us are really taking medical records in a lot of cases. We're not taking fluids. We're doing a lot of the underwriting over the phone or behind the scenes. And because of that, it really was a good fit for the environment that we're in today. And we didn't have to make a lot of adjustments.
And anybody, their respective companies make some subtle changes to the age limits? And if so, like, how's that working out? What's been the response from the distribution?
Steve, we've at Pac Life for Premier Care, we've put a cap at the maximum issue age being that of 70. So for all our products, typically it's 75. We dropped it to 70, I think back in maybe May or June. It's something we reevaluate every month, but I do see probably for the foreseeable future, near term, we'll probably stay at max age 70.
Got it. So, the traditional marketplace, I'll comment on that for a second. We've seen stability. We haven't seen many companies saying, I don't want to do this anymore. I think recently we've had one that said they're sunsetting or suspending their sales just because the life insurance portfolio that was taking off for them. They wanted to focus their efforts there. But we have seen a couple new market entries. One was a re-entry, one was an entry in the last 5 years. And so I think, we've got certainly a much smaller lineup of traditional carriers in the marketplace, but they, when they're talking to us, they want to sell this business. In fact, the IRRs or the profit margins on these products are very positive for them. They're just trying to figure out how to sell more of it because clearly we're seeing that the combination life and then long-term care or chronic illness or accelerated death benefit market has really taken off over the years. That's for a guy that started in the traditional market, I'll just say, you can't be a purist, right? You can't beat up one to sell the other. And that's why I have such great relationships with the folks on this panel. that I'm happy that there are more long-term care planning solutions than ever before. And frankly, I could go up and down the line here and look at multiple ways to solve the problem with each one of the carriers that are represented here. So I pulled up some LIMRA data, and it showed about 80% of all long-term care planning solutions are taking place on a life insurance chassis versus a traditional chassis. So Tony, what have you seen in terms of trends in your business over the last year or so?
Steve, when you say trends, do you mean
Like
trends?
sales trends.
Yeah, from our business over the past few years, we've seen a lot of sales growth in this space, and we're coming at it from we're one of the newer entrances into this marketplace. And we entered in, specifying our, really our niche and where we wanted to play. But because of that, we've seen, tremendous growth over especially the past year. If you mentioned LIMRA data, if you look at LIMRA data year over year, we've doubled our sales in this linked benefits space. Again, a lot of that is due to the changes that have taken place in the industry. But we've seen a lot of growth, and we've seen a lot of that growth based off of some of the nuances and differences that we implemented when we made some adjustments late last year or middle of last year.
And can any of you, Ryan, can you comment on how you guys are doing in terms of sales growth or acceptance? Pacific Life has always had these chronic illness riders on their policies. How are you doing on the qualified long-term care rider side with Premier Care?
Yeah, Steve, good question. Pardon in advance. My dogs are probably about ready to bark here in a second. Somebody just walked to the door. Joys of working from home, right? So we continue to see growth in some specific channels that we've had a high focus area for the past 2 years. And that's really in the asset manager, financial planner space. And we've been very intentional with our focus. And even, I see on one of these bullet points that, hybrid sales have been flat year over year. We have seen some significant growth in certain areas. And I think we do have a good value proposition where we are. But again, it goes back to not so much product, but what value add does our team, our wholesale distribution team, bring to the advisor? How can they help them have the conversations? How can they be there for point of sale help and delivery of the policy? And that's where we've seen the growth when we find advisors who truly want to partner, and we'll give away an opportunity just to continue to deepen that relationship with the financial professional.
Right. Tracy, like as a sales leader, fellow sales leader, as you grow, it's hard to continue to grow at a certain pace. Do you think the slowing down was partly that, or do you think it's COVID related?
Well, yeah, I mean, obviously it's a lot easier to move a small number than it is to move a gigantic number, as I'm sure my friends that are on this phone from Lincoln can attest to. We're trying to move big numbers. So, we came out in July of last year, One America did, with our new pricing structure. And we came out and it was fairly ambitious compared to what the industry looked like. And what we saw, as I mentioned earlier, was just over time, some of those pricing actions, which are starting to bring things up a little bit closer to parity. But right on top of that, of course, right, we were just starting to make a little bit of recovery from the pricing increase in July. And then COVID hit. So I think it's just kind of a twofer right now. We're kind of getting hit two different ways. And, while all of our sales teams have made the adjustment to get to being, virtual, we're just seeing that it seems like it's taking a little longer for the advisor to figure out how to do it. And, in reading some of the studies from different industry organizations, what we're seeing is that advisors who had an established book of business prior to COVID hitting, they're still faring pretty well. It's the advisor who's still trying to build their business who's really getting hit hard in this environment. So we're trying to come up with ways all the time about how we can help that advisor, continue to recruit and build their book through this really crazy time in our life.
Hey, Brandon, are you seeing more growth in your sales coming from financial advisors, or is it the insurance specialists out there?
I'd say it's really across the board, Steve. I think certainly there's been a focus on what we call, financial professionals. So that holistic planning that's going on. And then also we've seen a lot of success in the bank space. And so that's an area that certainly has been impacted with COVID, because people aren't, going into the branches and having those conversations at all, really. And so we have seen that be impacted. But as far as our sales, we're up considerably year over year. And I think that's just really a benefactor of being a relatively new entrant in the marketplace. And we're confident in the pricing that we have in place. And we've been able to pick up some of that share as a result of some of the reprices that have gone on across the board.
That's great. When it comes to plan design, and we're not going to dig into the specific products, but just macro level, we've seen in the traditional market where, given the new reality of pricing, we're seeing a lot of people hedge against the risk or co-insure against this risk, where they used to solve for the entire long-term care risk, and now they're not buying as much. In order to keep that sticker shock down, a lot of advisors are showing some, hey, let's co-insure some of this. Tracy, are you seeing the same thing in your world?
Yeah, absolutely. I mean, I've been hearing a little bit about, producers who are taking sort of a gap kind of approach, where they say, how much money are you going to have coming in? How much money do you need to sustain your lifestyle? What does that leave you? And then how much of that would you be able to apply to the long-term care situation should it occur? And then they're basically making up the difference with long-term care insurance. So I'm seeing a little bit of that. I'm also seeing, just kind of younger advisors, and somebody actually posted a question about approaching the younger market, just seeing people who are basically stacking insurance policies. So while you're a little younger and still have some of those family obligations, you're buying a policy that's not going to cover the whole amount. But then, a few years later, you buy a second one to sort of help. And you basically build a long-term care plan from that.
Another trend that we're seeing, and Ryan, I'll ask you to comment on it, is more ongoing premium payments versus single pay. What do you guys think about that? Are you comfortable with that as a carrier nowadays?
Yeah, good question, Steve. Historically, we've been single premium. We launched Premier Care back in 2012. We are starting to see a shift into our multi-pay, annual pay type of products. But as you and I have chatted many times, I'm definitely a fan of some type of life pay option in there as well. So yeah, definitely think that's a good opportunity. Something that Tracy said, thinking about the younger, how do we engage younger clients to purchase some type of long-term care plan? As we think about individuals 45 to 60 years of age, they've probably experienced long-term care in their family. I know we are really targeting that market specifically too, because they're very open to that conversation. I think we all can share that experience factor and understand that. But that's really where we're trying to help advisors think about their book of business in a different way. It's not just clients in retirement, it's clients who are maxing out other qualified plans. They may have some type of life insurance retirement plan in place, but let's throw in a long-term care solution as well.
Yeah, so we've seen, and Tony, you've seen in your business more multi-pay versus single pay?
We've seen a good mix of both multi-pay and single pay.
Yeah.
We also see, something similar to what Tracy had mentioned around stacking. If you're approaching that earlier age, it might be a life insurance sale someone is more focused on at that age, and adding an LTC rider to that type of policy. But then later on in life, LTC is more of a concern. Or even a few years after that, LTC starts to be a concern when a family member or a friend has an LTC experience, and then you start to transition to, Steve, what you had mentioned, maybe an extended pay on one of our linked benefit products.
Great, Brandon, are you seeing the same trend where you're seeing a healthy mix or more of one than the other?
Yeah, I would say one thing that we've seen a lot of success since COVID started. I mean, everyone has seen that's in the term business has seen their term business increase. We do have a chronic illness conversion agreement that's available on our term chassis. So we've seen some pretty robust growth with that solution as well. It doesn't add a huge expense to the pricing for a term product. So talking about driving to the lower age consumer, that's an area where if they want to have that accessibility later in that term product to convert it, they can add that to the term products.
Oh, interesting.
That's an area where we've seen a shift, and we've as far as our mix, we launched our product in March of 2017 as a single pay only, And so really that's where we were getting all the sales. And then in May of 2018, we launched our multi-pay version where we have slowly seen that shift. We're still about 70% single pay and 30% multi-pay, but that is an area that we're focused on continuing to drive more of that multi-pay business.
Yeah, I mean, I still, as a consultant, I still think the asset repositioning, concept has a lot of legs, and but on the other end, sometimes I'm dealing with an affluent client that says, I get it, it makes a ton of sense, but I'd rather stretch this over a 10 or 15 year period. So,
Right.
The more flexible premium payment options, speaking for distribution right now, the better. We like to have that flexibility. We have seen an interest in the industry in group long-term care insurance solutions with a heightened focus on financial wellness and retirement readiness programs being out there. These group programs, whether it's on a group life insurance chassis, a multi-life long-term care chassis, or frankly, a hybrid combination life and long-term care chassis at some point, I think there is interest in employee offerings. Have you guys seen this, Tracy?
Yeah, I mean, we hear a lot of feedback that carriers, distributors are interested in having sort of a work site program and maybe couple that with sort of a, executive carve out situation. We've heard a lot of that feedback, and we have been exploring it. I would say that it's on a back burner versus a front burner though here at One America.
Got it. Anybody else want to comment on the work site stuff?
Steve, it's something we're evaluating here at Nationwide as well. I don't know if it's on the back burner, but it's something that we're working on and actively trying to figure out where it fits in our portfolio.
Great. Another thing that's going on that is really interesting, it's called the Washington Long-Term Care Trust Act, and it is a law, and it is a social long-term care insurance program, meaning there's a payroll tax to be determined as to what that tax is going to be. We think there might be some changes coming up, but it is a payroll tax, so all W-2 employees beginning 2022 will have money taken out of their paychecks to pay for a limited long-term care benefit. Please understand, I'm not beating up this program. I'm not the private insurance guy saying this isn't the way. In fact, I personally believe that some type of public and private partnership might be the best way to solve America's long-term care problem. That being said, there is a social long-term care insurance program called the Trust Act. I think other states are looking at the Trust Act. I'm not sure that any are close to implementing a program like this because, again, it is a law and it does take a while to get this thing up and running. Anybody want to comment on the Trust Act or what they've seen of it?
Well, I can comment on, I'm on the ACLI LTCI committee, and there's now been a motion filed. I don't know if I'm using all the right legal language, but to eliminate the ability to utilize that law when you're purchasing a long-term care product that's a hybrid product. So that's something that ACLI is actively getting involved with, just to see if we can stop that from happening.
Got it. So the elephant in the room when you're talking about long-term care is in-force rate increases. And you're going to continue to see more of that on the traditional long-term care side. We titled this session LTC 2.0. Well, 1.0 is painful, right? 1.0 you can't run from. I know many of our panelists here, maybe Brandon and Tracy, have lived inside of different companies before. And look, there's pros and cons. The pro today is that the products that you're distributing aren't having those problems, are not going to have those problems. The cons is we're delivering a lot of rate increases to Americans out there. The good news I want to go back to is that carriers are paying claims in volume. The long-term care industry is delivering on the promises that they've made. And also these carriers are doing a very good job with providing landing spots or options for consumers. But I will tell you, if you've sold long-term care in the past, these rate increases are going to continue. As the carriers try to get a little bit healthier on these blocks of business. But we are seeing rate stability on the new stuff with traditional long-term care. Again, brand new actuarial assumptions, and we think it's going to be much more rate stable business. We are rooting for our friends at Genworth. We are, as an industry, our friends over there, we hope that they cross the finish line as it relates to their transaction with China Oceanwide. So hopefully it'll get done soon. So that's just a marketplace update. what I want to do now is shift gears and talk best interests, suitability, fiduciary duty. These are buzzwords in the financial services industry and for insurance advisors. So Tracy, what are you guys doing to assist advisors and insurance specialists in this enhanced regulatory world that we live in?
I mean, for me or for One America, it's very difficult to say that a product like One America's, asset care or annuity care is not suitable for somebody. We look at it, you mentioned something a little earlier about this asset reallocation strategy. So if we can have an advisor, take a little bit of money out of a portfolio and use it to protect the portfolio and to protect the client, like it would be a difficult argument from a suitability perspective that that's not the right thing to do. And I'm sure all of my colleagues here on this call would agree that, putting in place a long-term care plan it is a good thing to do for a client. So from a suitability perspective, we're just not really seeing much there.
Got it. Tony, have you guys thought about like the new sales process? If we as distributors have to document virtually everything, have you guys thought about that as it relates to suitability?
We haven't focused a whole lot on that, similar to what Tracy had said. One thing that we did think about is, it's not suitable, or in some cases it's not possible for all clients to have a large lump sum of money to put into these policies to cover their needs. And that was one of the reasons, and I think a lot of us did that, is we've extended these premium payments out and we've enabled more clients to fit into what that appropriate suitability requirement would be in order to create a plan, fund a plan, and purchase one of these policies based off of the income and their needs. When we looked at this, we said, there's these high net worth clients that are able to do these things. The traditional space is changing, and that's typically where we went to for some of those extended payment options from a suitability standpoint. How do we bring our products into that market and make them suitable for that type of market? I don't know if that answers your question, but that was our thought process around suitability.
And I think it makes sense. Like I've had offline conversations with Ryan and Brandon about this as well. And I think from a carrier's perspective, they are providing products, that certainly are competitive, that they're valuable, they're suitable. I think what's challenging for us as distributors is, hey, what's suitable when and where? So Ryan, can you talk about, I've got traditional long-term care, I've got these hybrid with qualified rider plans, I've got accelerated death benefit or CI plans, or even annuities. What's suitable for a client? What should advisors like us do?
Yeah, I think it all goes back to the objective of the client, the plan they're trying to put in place, right? I mean, if they are looking for a death benefit need and they need to throw on and tack on some type of chronic illness rider attached to it, then that's probably going to be more suitable and appropriate for the client. But if there's truly no death benefit need, then there's obviously carriers on this panel and us as well, where we provide primarily LTC protection. And that's really what they're looking to do, is protect the portfolio from the rising cost of care versus a death benefit, whether it's a single pay or paid over a period of years. There's solutions that we all offer that would be very suitable for that client. And it really depends on their plan, asset threshold, income that they receive every year, et cetera.
Brandon, when people call us up and say, what's the best fit? What's the best product? We're not trying to be evasive, but we answer oftentimes, it depends. Is that the right answer?
I definitely think it is. And Ryan touched on it. If people are looking for a death benefit, a lot of times these, whether it's an asset-based product or a traditional product, is not going to be the best solution. However, if their main focus is long-term care, then that's where the advisor needs to have that suite of offerings that they can show to the client. And really, in our conversations, we talked about it briefly previously, as far as the differences between single pay and multi-pay. One of the things that I do think comes back on the advisor is the suitability of which plan to offer when you look at the leverage. If the client has the resources that they can redeploy to a single pay, they're going to get the most amount of leverage when comparing to the multi-pays. And so that's one area where I do think advisors can continue to educate the consumer on the differences of the payment plans. And then, like you said, traditional LTC still provides the utmost leverage. And so if that's what they're looking for with having that LTC benefit, then I definitely think there's still a place for it.
Yeah, I think it comes down to like what Ryan said. What are you trying to accomplish?
Yeah.
What's your primary concern? Is it solving a long-term care problem, or is it solving a life insurance problem? But, again, I go back to, there are more options than ever before. But, when I think about best interest, suitability, fiduciary duty, I think the onus is on us as professional advisors to guide our clients to make the right decision. But beyond that, I guess what concerns me as a distributor, as a GA, is that, well, we've got to document that. And so that's where I was going. And I don't think we're there yet. I think this is a TBD in terms of how do we document all that? How do we memorialize all this? So 10 years later, 5 years later, a year later, somebody asked me, why did you select that company? Why did you select this sales concept versus the other? We as professional advisors need to get ready for that type of conversation. All right, I want to pivot to technology, right? We live in this like Amazon delivery world. And if you hear something, it's probably Amazon ringing the bell. There's another box at my house. And how are your companies, insurance still feels clunky to buy, right? It's still hard to buy this stuff, even with your product lines. Tracy, how are you guys making it easier on advisors and consumers when it comes to the process?
Yeah, I mean, I would say from a perspective of just kind of looking forward into 2021, we are 100% dialed in on that, about making this buying experience better and just laying it out in a couple of different pathings. So like looking at what is the customer experience, and how do we put technology in place to make that a good experience from the time they start thinking about long-term care insurance all the way through until they get the policy in their hand. And then thinking about it from the advisor's perspective, like how is that experience? And then trying to really dial in about how we're going to make this experience for them better in 2021 and beyond.
Got it. Ryan, are we ever going to get to that, like click and buy, like I click on Amazon?
That would be interesting and nice, right? It's funny. Pre-COVID, this technology conversation was definitely part of our planning conversations. But that was more of a 5-year plan, right? And obviously once March hit, it fast-tracked a lot of our conversations and our initiatives. To Tracy's point, I think 2021 is going to be a big focus for us as well. Whether we get to that Amazon style, click it and you get some type of policy, who knows? But I do know that we're partnering with several tech companies and to try to put together some platforms within certain institutional broker dealers to make it seamless and not only the clunkiness for the consumer, but also clunkiness for the financial professional. That financial advisor who doesn't do long-term care or really insurance because of all the paperwork and then the underwriting. How can we make it seamless and simple for them as well so they can have those conversations with their clients? So we're definitely focused on it as well at Pac Life.
Tony, are you guys singing the same tune as Ryan and Tracy?
Yeah, we're not to the point where it's Amazon like click it and you've got a policy. If you ask my boss, he'll say we're going to get there. We are though to the point where we do have electronic applications, electronic processes. You can submit everything electronically, and we can electronically deliver those policies. And that was a big investment we made this year, and we're going to continue to make that investment into 2021 to make improvements on those processes. It's been an important part of doing business in this COVID environment. And we feel lucky that we had it and that we were able to make some quick adjustments to improve on it during this time.
So Brandon, with like motor vehicle reports and MIB checks and prescription drug screens, that's a lot of information right there. Is that what you guys are focused on too, is simplifying the turnaround time?
Yeah, so we've, as everybody has stated on the call, we're laser focused on the ability to process business as quickly as possible. And so we've actually just launched a toolkit on writing secure care remotely. So you technically could go out today and have a Zoom meeting with a client and take an application via the e-app and do the e-policy delivery So we've built all that into the process where you technically don't have to sit face to face with the client to take the application anymore. And so that's been a big improvement this year and something we'll continue to focus on. Another feature that we did add to our process earlier this year was the ability to schedule your telephone interview online. And so not necessarily waiting around for somebody to call you for your telephone interview. If there's an email address in the application, we will reach out within 24 hours to send a link to the client to be able to schedule that interview at their leisure. So
That's great.
really trying to make it easier in the process for the consumers at the end of the day to get this coverage.
Got it. So let's, we got just a few more minutes and a few topics left. So let's talk marketing. We talked about the LTC Awareness Month, but any initiatives, 2021 initiatives that you give a tease on, Brandon?
The focus will continue to be on, writing the business as quickly as possible. We are focused on getting more videos out. And so we've got a whole library of videos today. You can actually access it on our website. We have a standalone website that you can access. And so we will just continue to present more marketing content that the consumers can view along with the advisors as far as educational.
Tracy, you guys have been great at that too, in providing social media content, campaigns, or tools for agents to use. Talk a little bit about that for a minute.
Yeah, so that all those things have been in place for quite a while, in addition to the electronic format for doing business and all of that. But from a pure marketing perspective, we're just really going to try to help. In 2021, the initiative is to try to help financial advisors connect in a more meaningful way with their customers in an interactive sales environment. So that's kind of where we're headed, and then just trying to help that customer then through the journey, through our marketing efforts.
Yeah, Ryan, anything you want to add there?
Yeah, 2 points I'll make, Steve. One, materials that are not product specific. We talked about that earlier. Much more concept oriented, fitting into a financial plan, how it fits into the plan with assets and fixed income, et cetera. The other is, looking into Q1, Q2 of next year, who knows if we're still going to be working from home or how things are going to open back up for us. We're definitely highly focused on continue to help advisors engage virtually. I mean, it's been incredibly successful for us so far in the past 5 or 6 months. And we're going to continue to work on that with different types of presentations to help those advisors in those conversations. So
Tony, last thing on marketing. You guys, I've seen all kinds of good information, not only from Nationwide, but from your Retirement Institute. Can you talk a little bit about that?
Sure, we have a program in through our Retirement Institute that's a real in-depth plan around LTC. It's available to any advisor that's on this call. It's something that our institute puts together. It's 3 to 4 pages, and it takes into consideration, what those future needs would look like. We've not only done that, but we've even simplified that process through an app that you can download through, whichever provider you're on, but an app that you can download that'll give you a quick snapshot of the same thing.
Got it. All right. So let's seminars versus webinars. Just anybody take a minute, 30 seconds. I mean, it used to be seminar heavy in this world. Have people converted over to webinars? Is it working? Tracy, I know your firm, promoted a lot of those.
Yeah, I mean, just like everybody, right? We're all doing these video conferencing, but so I think, video, I think will continue to be the name of the day through the COVID environment. And I know, for us, we're not going back into our One America Tower in downtown Indianapolis anytime soon. So, right, our sales teams have got to continue to figure it out virtually. And I think that the video format is the best. I just think at least you can see people's face. You're kind of eyeball to eyeball, even though it's not in person. I think at least it is a little bit more personal than listening to a voice on a blank screen. So, just using technology in a bunch of different ways to get your messaging out as a carrier to the advisors so that they can better be positioned when they're in front of a customer.
Yeah. And I'll just give a tip for advisors out there. Sometimes less is more. We as content marketers, we want to get stuff out there. But because we're all fatigued with Zoom and these webinars, and by the way, thank you everybody for taking time today. We had a tremendous attendee number here, but we're all fatigued with all the stuff that's being thrown at us, and sometimes less is more, or more meaningful content is better than just spraying out there. Underwriting for a second, there's like a misperception that this stuff has unreasonable, because you underwrite for morbidity and mortality. Tracy, in terms of like overall declination rates with your products, what is it? Give me a ballpark.
6 to 8%. It kind of waffles between, as far as just straight up declines.
Yeah.
And that's one thing about One America, is that we don't just have a pass or fail kind of underwriting threshold. For us, we can say, yeah, you can get, a preferred rating, you can get a standard rating, and then you can get all the way down to table 8. So
Wow.
that allows some people who are maybe a little bit less healthy to be able to qualify for some benefits still. And
Ryan,
then we
what about
also
you
have
guys?
our annuity care business, which some of the even more unhealthy people can pivot to the annuity care business.
That's right. I forgot about that. Ryan, what about you guys?
Yes, Steve. So we do the simplified underwriting. We don't pull the APS, no medical records, no blood, et cetera. Our decline rate's probably about 20% or so, 25%.
Okay.
I think it depends on the month.
Yep. Tony?
Yeah, we follow a similar model that Ryan just mentioned, and depending on the month, we're anywhere from 15 to 18%.
Okay. I mean, Brandon, what about you? Last one.
Yeah, just along with line with everybody, our decline rate's about 25%. I will say that we still do pull APSs for cause. We're only doing it about 25% of the time. And when we look at that, obviously it's adding some expense to the process, but really what we're trying to do there when we pull that APS is to get the person coverage. So they've taken the time with their advisor to get educated on the product and to apply. And we're pulling that APS on 25% of the cases to do our best at trying to get them coverage.
Yeah, and by the way, just context, but in no way did I ask the question to compare decline rates across companies and say who's better. It's more of a matter, I think there was a misperception out there that people think that you can't qualify for this stuff, or because it's both or morbidity and mortality underwritten, it's tougher. And I'll just say that if you're in your 50s and 60s, and you want this stuff, you're gonna most of the time you're gonna get coverage. And I would advise advisors out there to manage the client's expectations based on their age. Just say, hey, folks your age around this many % usually get declined, so that leading into this transaction, they know kind of where they stand. I want to talk about sales strategies. Again, we promised in the last 5 minutes here to leave people with some best practices. So we'll start with you, Brandon, since you're here. What are top producing firms or advisors doing that right now to sell?
Yeah, I think it's getting back to the advisor education and more material that the advisor can use with their clients, and trying to make that consumer awareness at the forefront of the conversations.
Yeah. Tony?
I would say embracing this virtual technology, embracing the fact that they're able to do Zoom meetings with their clients, embracing the fact that you can do more of them potentially, and really leveraging that. I know there's a perception that it's more difficult to do business right now because of this. I'd say one thing that we don't want to overlook is just the leaps and bounds that we've taken from a virtual standpoint. All of our kids are learning virtually. All of our clients' kids are learning virtually. Nobody knew what Zoom was or how to use it at the beginning of 2020. And now, my 7-year-old daughter can do a Zoom meeting without me standing over her shoulder. Our clients, or your clients, are able to do things and interact with you in a different way. And I'd say embracing that going forward is a new opportunity for everyone.
Yeah. Tracy, you want to add to that?
Well, I mean, listen, at the end of the day, there's one thing that there's a couple of things that haven't changed. One is the need for people to have long-term care.
Right.
The second is the best way for an advisor to be able to sell long-term care is to talk about it.
That's
Right. So I know on this call, we probably have a lot of long-term care specialists, people who are extremely interested in learning more about the long-term care, topic. But a lot of our advisors are just onesie twosies, right? So it's just having the conversation, and not just having any conversation, having the right conversation, having meaningful conversations with their clients. That's the first thing that's gonna engage the conversation in the right way. And then in addition to that, I would just say, Mark Sigmund just asked on the questions about carriers offering pre-screening process. OneAmerica does have a
Oh, she froze.
I think we lost Tracy.
I think we lost her. Oh, you came back.
Oh, here I am. I don't know what happened.
All right.
So we do have the pre-underwriting inquiry form that is available for that. And then I would just say the last thing, which kind of gets back, Steve, to your question, is just around finding out where, there are alternate funding sources that advisors can look for, qualified funds, looking for money from annuities that they can 1035, looking for, cash value in life insurance that they can 1035 exchange to turn it into a long-term care plan. So just trying to really be more holistic in the approach and having those right conversations.
Got it. Ryan, I'm going to start with you. We've got 2 more minutes. Predictions for 2021. Where do you think this business goes?
I think we're going to continue to see some growth in the asset-based hybrid market. I do. I think that this virtual world is teaching us, to what Tony said, to teach us how to do it differently. And we're just going to continue to help advisors engage in the need, like Tracy said. But as recent survey I just read, perceived value of long-term care for retail investors has never been higher. And it's now our time to capitalize on that opportunity.
That's great. Brandon, any other comments?
Yeah, I totally agree. It's now's the time for these products, especially when you look at the flexibility that all these carriers offer day in and day out. So someone mentioned at the beginning of the call, there's never been a greater focus on people's health in 2020. And that's one of the areas where you're going to continue to see people look to cover themselves for a long-term care event.
So a good friend and I were talking yesterday morning. We were talking about an analogy that we came up with, where my kids are going to the doctor all the time, and there's a pain scale, right? 0 to 10 in terms of how much does it hurt. And don't wait till 7, 8, 9, 10 to plan for long-term care or help your clients plan for long-term care. You've really got to plan when it doesn't hurt. And just again, with the demographics in our country, more of us have experience with long-term care. So in my opinion, there's never a better time than today to talk about this planning. I want to thank our panelists for taking their time. I always learn something when I talk to each and every one of you guys. I want to thank the folks that have taken an hour out of their time to learn more about this planning. And I guess we'll open it up to some Q&A for the last 2 minutes. Let me look at some. Carol, do you want to add anything?
No, I think if you see something on the Q&A that you would like to respond to, we have about another minute or two.
Okay.
And I'm just like, I think everybody who's on this session, very grateful, tremendous amount of information, Steve, and just a tremendous session altogether. Any questions you want to answer?
There's too many, which
There
I
are
love.
too
We can
many.
save them, but there's
So
too
let
many
me,
to do it.
yeah.
I know I'm excited about the future upcoming sessions the rest of the day and tomorrow. And again, please go out to that NAIFA LECP site. Thanks,
Thank you,
everybody.
Steve. And thank you to everyone on the panel. I'm sure that everyone who is listening and has joined us agrees with me. It was just absolutely terrific. I was taking notes like a crazy person, like everyone else. And I think it speaks to the fact that our industry is expanding, that we are definitely taking things now, understanding the consumers better, but we just really do need more agents and financial planners to talk about this so that we can grow the industry. And I think that kind of relates to our next speaker. I think since our industry is growing, I think we have been relatively quiet about what it would take politically and from an advocacy point of view to really help us grow. And, that is something that NAIFA has as expertise. So again, thanks to everybody. We'll have a break for 2 or 3 minutes. And then please join us for Diane Boyle, who is our Senior Vice President at NAFA Government Relations.
Thanks, everybody.
Bye.
you.
Thank you.
Hello, everybody. Okay, well, that was really exceptional. I'm sure you agree. And now we are really going to have another session where you're going to want to have a paper and a pencil, because Diane Boyle, our Senior Vice President of Government Relations at NAFA, is outstanding when it comes to knowing the political scene. So let's get right at it. Welcome, Diane.
Great. I think you can hear me, but I think, Andy, I need you to release or give me permission to show the video if you want to see that. I'm going to give him a minute.
Okay. I'm glad to take credit for it this time.
Okay, I have it now.
All right, thanks.
Permission to access. Okay, here we go. Wow, I'm gonna have to ask for a better placement. That session was phenomenal. I'm nervous about following that. And I'd like to share my appreciation to the veterans who are out there. We appreciate your service and sacrifice that both you and your families have made for our country, so thank you. With that, let's go ahead and get started. We'll talk about who's going to lead long-term care policy now that we're sort of past the elections. And I say sort of, because if we go to the next slide, you'll see that we're not quite done with all of the election results. What we're going to cover today will be actually the results of the election to the extent that we know them. We'll talk a little bit about the state and federal efforts that are ongoing in the policy arena. We'll talk about opportunities to increase product awareness. And I'm going to kind of slice that in as I give the presentation, because I think there are opportunities that you'll see along the way. And we'll end with a little bit of a call to action. We'll go to the next slide, please. So on the election side, we're going to look at both, well, three components: the president, Congress, and then we'll look at some of the state elections. Next slide, please. So the results are coming in, and the team here, the production team at NAFA, is phenomenal, and they were really patient with me as I went through, and even this morning as the last of the Senate elections were called and said, hey, can you swap out the slide deck yet again? So on the presidency, it takes 270 electoral college votes in order to win. Biden has 290. If you take out Arizona, which has 11 votes, he's still over that 270 threshold. President Trump has 217, and there are still 31 electoral votes that have not been called yet, and those are tied to Georgia and North Carolina. In the Senate, in order to hold a majority of the Senate, which determines who the leadership is going to be and how that direction, and having the majority in both the House and the Senate, what you're really looking for there is who's going to allow what issues to come to the floor, what's actually going to get the vote. They set the agenda, and that's why it's really important. So in the Senate, we see that Republicans have 50. Alaska called their race today, which put Republicans at that 50 mark. Democrats have 48. There are 2 races in Georgia that have not been called. They're going to go into a runoff. So we won't know that until early January. It's expected that the Republicans will hold those. If they do, then the Republicans will absolutely hold the Senate majority, much as they do in this Congress. If those 2 flip to the Democrats, then it's actually going to be a Democrat control, because it would raise them, and the vice president would come in for a tiebreaker. It would end it at 50-50, and then of course Harris would make up that majority. But it's going to be a narrow majority regardless of how you spin it. So getting consensus in the Senate is still going to be tough. On the House side, you need 218 votes in order to have a majority in the House. The Democrats just hit that at 218. We still have 16 races that haven't been called yet. Go ahead and go to the next slide. So the president elect, if you will, Biden has, his transition team has talked about what their priorities would be. They're looking at, obviously, COVID-19 relief is still needed. Once you get past that relief, what I call is the economic recovery. So you're going from relief to recovery, very much tied to that pandemic and the cost associated with provided that relief. Then you're looking at racial equality is high on this list, as well as climate change. All with the exception of climate change. I think when I said I'm going to talk about how you can weave in those conversations, all three of those top components are opportunities for us to talk about long-term care. This pandemic has raised awareness of the need for long-term care planning, especially if you look at what had happened early on in the nursing homes, and we're seeing a spike again in nursing homes. For us to talk about the product and that it isn't just nursing home care, what type of care is available through our products and services. So have those conversations. Economic recovery, it's going to be a cost. So let's figure out how we weave into those economic recovery conversations the role that long-term care insurance plays. And then even in racial equality, I can see as being part of that conversation, because let's look at how we deliver those products and where we're delivering the products and how it helps those communities. Excuse me. Next slide. We're going to have the first female vice president ever. Kamala Harris is posed to ascend higher than any other woman in U.S. history. And this is significant because you're going to see me take a slant on the female component. Let's go ahead and go to the next slide, because I think that's a real opportunity for us. As I said, Republicans likely to hold the Senate majority. We'll look at the majority leader will continue to be Mitch McConnell from Kentucky. Minority leader would remain the same with Chuck Schumer from New York. Both of these gentlemen have worked really closely with former Senator and former Vice President Biden. So when Biden held, he was a colleague in the Senate. When he was in the vice president, he still had a very much hands-on approach to working with the Congress. And those relationships are good. So it's going to be interesting to see if, when priorities come through, especially when we get to, which we'll talk about the House in a minute, that interplay between what the House does and when it comes over to the Senate, how those successful working relationships will come into play in the Senate. Let's go to the next slide, please. With that, how legislation, especially long-term care legislation, falls into certain committees, and that's really important. That tends to be where we have our focus. So you look at the Finance Committee, you look at the Health Committee, which is the Health, Education, Labor, and Pensions Committee, and then also the Aging Committee. The Aging Committee, we're not going to see any changes in the chairmanship, but in the other two, we are. So Senator Grassley from Iowa currently chairs the Senate Finance Committee. He's termed out. He's going to go and chair the Judiciary Committee. So then you see Mike Crapo is likely to become the Senate Finance Committee chair. We'll see Senator Wyden, who is the current ranking chairman, remain as the current ranking, unless the Dems pick up those two seats in Georgia, in which case you'll have Senator Wyden as the chairman with Crapo as a ranking member. And then with the Health Committee, Lamar Alexander from Tennessee announced his retirement. And so next in line is Senator Burr. And we leave that as a likely because there's always a possibility that someone else is selected. But it looks like it's going to be Senator Burr. Ranking chair would be Senator Murray from Washington. She is the current ranking chairwoman as well. Again, unless the two Senate seats in Georgia flip to the Dems, in which case she would become chairman. Let's go ahead and go to the next slide, please. So Speaker Pelosi's job just got a lot more difficult. The margins in the House are really thin. The moderate Democrats lost 8 seats to Republican challengers. The progressive Democrats in the House actually gained. They expanded a little bit. So what you're going to want to watch is there is a group called the Problem Solvers Caucus, and it has both Republicans and Democrats, and it's those moderates that try to find issues that they can work on together, and then they agree as a bloc to vote in support of of legislation that they reviewed and talked about. And even if you go back to the Cadillac tax, I'm not sure how many of you followed that going through Congress last session, but the way that it was actually pulled off is that the Problem Solvers Caucus talked to Speaker Pelosi and had an arrangement where if there was a majority, they would bring something to the floor. And so they're actually able to bring the speaker when she needs Republican votes. By going to this Problem Solvers Caucus, they can get her to that magic number of 218, because in the House Democrat Party, you're going to see difficulty getting their more progressive members to agree with some of the more moderate members. So the fact that they have in total 218, that's what they need in order to have that majority to vote something out of the House. And if you are at 218, you have to expect that it's going to be really difficult to hold all 218 Democrats together. And so they're going to need some Republican votes to get things to move. So I think that's going to be really interesting to watch. Let's go ahead and go to the next slide, please. So on the House, and when I mentioned the first female vice president and said I was going to focus on females, this is where we're going to start talking about it. If you look in the House, the Republicans flipped 9 seats, meaning they were traditionally held by Democrat members, and the Republican was a challenger and picked up that seat. You'll see the different states in which they picked up those districts. But 7 of the 9 that flipped, 7 of those members are female. And even on the Democrats flipped 3 seats. So they had 3 seats that were typically held by Republicans that they then flipped, and they now have a Democratic member in those seats. And all of those 3 seats are females. Go to the next slide. So the reason that I'm focusing on females, if you talk about who has a natural interest in long-term care conversations, tends to be those female caregivers. And we know that women make up a majority of female caregivers, both in an informal family setting, as well as paid caregivers. And so the fact that we now have more women in Congress, it's going to allow, I think, for an easier conversation to get them to focus on this. They're already there. They're already talking about it. They've already had those experiences that we've all talked about. You know, the panel before said, when did you become interested in long-term care? And it was typically an event that had happened to them. And I think that's true even in the process of talking with consumers. It's once somebody has that experience that they become really interested. So not only are they going to have that experience, you're going to have perhaps people who have been in that caregiver role. And I think that's really important. So we're going to have at least 135 women in the 117th Congress, which will make up about 25%. So it's significant. Also, I think, and I don't have the numbers now, but we're looking at a number of LGBTQ members coming into Congress. And I think that's interesting because you're looking at non-traditional family units and how do they take care of planning for long-term care. So I don't have the data to say what their interest level would be, but I think it's something that we should watch because I think that's something that we're seeing changing in Congress and changing in our culture, and having information and conversations to talk to those individuals, I think is really helpful. Let's go ahead and flip to the next slide. So House Ways and Means, as I mentioned, this is the committee that has jurisdiction over our issues. We're going to look at Chairman Richie Neal, who's the current chairman, and Kevin Brady, so really no changes there. Good individuals to work with. And I think there's an opportunity for those two obviously to work closely together on any legislation that we would have before the committee. Go to the next slide. If you flip to sort of the state side of things, because obviously there's state issues as well, there was very little in the states that changed. If you look at it, we have the governors and the legislatures tend to be held by Republicans more so than the Democrats. And if you look at the trifecta, so this is where you have the governor, both in both chambers, the House and the Senate of the states, held by one party or another. And so you have 22 that have trifecta. 15 of the states actually have a Democrat trifecta, and 11 have split control. And there's one that we're still waiting to be called in Arizona. Let's go ahead and transfer to the next slide, please. In the governors, there were 11 that were in cycle, very little changed here as well. Prior to the election, Democrats held 24 governorships while Republicans held 26 after the Republicans picked up 1 seat in Montana. Go ahead and go to the next slide. The state legislatures you're looking at, Democrats did not pick up or hold any of the state legislatures. You saw the Republicans pick up New Hampshire Senate. The Republicans actually held the North Carolina House and Senate, the Pennsylvania House and Senate, Michigan House, Iowa House, Minnesota Senate. And switch to the next slide, please. So we're going to transition and talk a little bit about what are some of the congressional and state and federal opportunities that we have now that the elections have changed. Let's go to the next slide. And Bill Nash yesterday mentioned this, and he talked about Senator Toomey's legislation, and I teased him and said, don't steal my thunder, I'm talking about that tomorrow. And just last month, Senator Toomey introduced legislation. The challenge that I see here is that he didn't introduce it on a bipartisan level. So you really want to see, we talked about the narrow margins in both the House and the Senate. If you really want to move something through, it's going to have to be bipartisan. I think we can get bipartisan support here, but it's going to be interesting to see. And so what this would do is it would allow the purchase of qualified long-term care from retirement plans up to $2,500. And it would exempt the purchase from the typical tax penalty that's applied. Let's go ahead and flip to the next slide. And I think in the House, it wasn't offered in the House. We'll have to see a companion bill come up. And what's interesting there too is we're still waiting for, I was going to say, if you're looking at House members to say who could pick this up and really drive it. And you want to make sure that you have somebody that's on the right committee, because we talked about committees and who has jurisdiction, is there's a relatively younger member on the House Ways and Means Committee, Tom Suozzi from New York, and his race hasn't been called yet. But this session, he had said, I really want to focus on long-term care. So I think there were opportunities, but it goes to show the dynamics of the political side coming in to impact with sort of the policy side too. So let's talk a little bit about the state efforts. We did see some state initiatives in 2020. These are the states that we're looking at. Let's go ahead and flip to the next slide and I'll run through them quickly as to what we have. If you look in Connecticut, because they really do run the gamut, if you have an income tax deduction was introduced in Connecticut, didn't go anywhere. Go ahead and flip to the next slide. In Hawaii, you're looking at, notices coming out that they would have to be by certified mail or probably more than mail. So it was more than mail. Again, didn't go anywhere. Let's go to the next one. Massachusetts was interesting because they covered everything from long-term care tax credits, yay, to Medicare for all. Then they have legislation on the partnership program. And again, really no movement here, but it shows that there's an interest and it shows that it's not consistent. The next slide, please. New York also all over the place. So you have tax credits that are being offered. You have a number of requirements that would be imposed on the insurers specifically. They're looking for some transparency in rates, and there would be rate increase requirements and other sort of issues I'm looking through. I don't want to read the slide on to everyone. And they're kind of text heavy on the slides, and no, that's because I anticipate that they will be made available for everyone, and I want you to have that information. None of these passed as well, but it'll give you an idea of what's coming about in 2021 as well. Let's flip to the next slide. Rhode Island, they were actually simply updating their statute to conform with the NAIC model. Didn't get through maybe we'll see that come through in 2021. Next slide, please. Washington, and we talked about this yesterday too, and I think it was mentioned, we discussed it a little bit this morning as well, is Washington actually did enact something, and it was on top of and modifying their long-term care services and supports trust program. And what it would do would allow those individuals who already have existing long-term care policies to opt out of that premium assessment. And I think it was Tracy who mentioned the concern there is that hybrids don't count for this exemption. And so that's something that we certainly will be working on because we want to make sure that it's fair. But it shows that there's a little bit of an interest on long-term care on the state side. Not a lot that's getting through, but something that we still need to watch and work on. So the next slide, please. I want to talk a little bit about the Federal Interagency Task Force on Long-Term Care. We, NAIFA, as well as a number of company insurance representatives, testified before the Treasury on this task force regarding their long-term care recommendations, that they would be reviewing and making recommendations. And the idea behind the task force is that it would pull in all of these different federal agencies who would have some jurisdiction. They'd come together, they'd sort of review the NAIC efforts and figure out if there was a way for the federal government and these agencies to work together in order to promote specific long-term care initiatives. Really interesting. So I did put, because the next slides are really going to be text heavy, a link, that link will get you to the full report that was issued in August. You're fine, go ahead and to the next slide. So I'm going to run through what their recommendations were, and they broke them down in the innovation and product development. It was one category, and they talked about combined products, that's great. So the session before we were talking about product development, really interesting and really good, because that's something that this interagency task force said, yep, you know what, that's something we can get behind and something we can support. What I want to call out is on the group products, however, and that was really disappointing because that was something that the industry was supporting. And the task force came back and said, no, you know what, we don't recommend that the employer safe harbor be put in place, nor the purchase of long-term care within retirement accounts. And the reason there is that they just didn't know whether it would have a meaningful impact, and so they weren't recommending it. So I think we have a bit more conversation to do in order to get some support behind some of those group products, because there's a disconnect between what we're seeing from regulators and legislators on what would be valuable versus what the industry is seeing as being a real opportunity. So we have some work to do there. Incidental benefits was something that, yeah, we can look at that too. Let's go ahead and go to the next slide. So then they said, well, let's look at regulatory efficiency and alignment. Where are there opportunities there? And that was sort of a good outcome, if you will, for the industry. Everything that we sort of proposed was sort of a check. Yep, let's do that. Let's look at inflation protection under HIPAA. Let's look at it under the Deficit Reduction Act. Let's look at some additional consumer protections. Let's look at the review and approval rate process and see if we can't streamline that a little bit and have some efficiencies there. Continue to monitor that, working with the Federal Insurance Office as well. So those were all good things that came out of the report. Let's go to the next slide, please. Then they said, okay, on financial literacy and education, yeah, this is also something that we think we need to do. Let's work together through Treasury, HHS, DOL, and the other agencies through what is the Financial Literacy Education Commission, which is under the Department of Treasury. And let's see if we can't get information out there. I think this is a real opportunity for us. We need to make sure that we're tying, and we heard both yesterday and this morning, making sure that we have long-term care planning as part of financial literacy and retirement planning conversations. And so I think the more that we can tie it to financial literacy and education, the more that we're going to get awareness of our products and moving forward. Let's go to the next slide, please. And I'm seeing the Own Your Own Future. I love that campaign. I'll talk a little bit about that in a minute. This is where I see some challenges. Typically, when we go to Congress or to the state legislatures, we're talking about what tax incentives can we put in place. And we presented some tax incentives to the interagency task force as well. And they came back and basically said no. No on some of the new tax incentives that we were requesting. They also said no, though, to alternative public programs, which I thought was pretty interesting too. So that would sort of be anything that would push out the private sector, so that even though it was a no recommendation from the task force, it was a yes, in my opinion, to the industry. And I think that's really good. And even great news, if you go from sort of the bad to the good to the great in the middle, is on retirement accounts. The task force also recommended that we have or pursue the idea of eliminating that additional tax on early withdrawals from retirement plans in order to purchase long-term care. That goes back to the Toomey legislation that we talked about earlier. That's where I see another real opportunity for us. Is we have the interagency task force saying this is something that they support. We have the industry that's saying it could be a good thing. You have legislation that's been introduced. That's lining up. Now, remember, just because it's been introduced in this Congress, there's probably little to no chance, I'd even go no chance, let's forget about the little. There's no chance that that's going to be enacted in the 116th Congress. That's this Congress that ends at the end of the year. So it would have to be reintroduced in the 117th Congress. I fully expect that Senator Toomey will. We want to make sure that we're making it bipartisan, as I said, and that we get it supported on the House side as well, and really get some momentum there. So I really think if there's one takeaway in the legislative side of things, that retirement account access is going to be where we have an opportunity. Let's go to the next slide, please. So opportunities to increase product awareness. I think if you look at the pandemic, has created a real awareness of what's going on. So let's talk about the product as well. As we have those conversations, there's heightened attention to long-term care planning, the nursing home situation that I mentioned, looking at those female lawmakers who are more likely to have had a caregiver situation than their male counterparts. The fact that their numbers are going up are really important. I think tying it to financial literacy and retirement planning is key and a real opportunity for us. And I think the go-to spot is the LECP network. So let's share our ideas and continue to have those conversations. I'm getting close to my time. I'm going to go ahead and flip to the next slide, please. And I think we can wrap this up. Our call to action today is really simple. Educate, educate, educate. You have to have those conversations. Make sure that you know where those opportunities lie. So I hope that I've given you some tips on where within the legislative process we can go. Make sure that you're working with each other and with the consumers to make sure that they have an awareness of what it is that this industry offers to them, the need for them to have those planning conversations, and to make sure that we're talking to lawmakers. Not necessarily about the specific ask, although I think what we want to do is look at the legislation that Toomey is offering, and that is an opportunity. But beyond the ask is making sure that lawmakers are aware. Do they understand the industry? Do they have an appreciation for how the industry can serve to provide some relief in this pandemic environment that we're living through? Do they understand the role that the industry plays on taking expenses off the public dole? If you didn't have long-term care policies in place, who's going to pay for the long-term care needs that our citizens have? That's going to fall back on Medicare, Medicaid? Are there resources there to cover it? Not currently. So anyway, making sure that we have those conversations are really important. I'm going to pause for a minute, and Carol, I think we're close to time. I'll read through the questions. I wasn't able to monitor the chat and have that conversation, but I will go through and try to answer your questions.
Well, here's what I would suggest, since we are very close to the end of our time here. We're going to be sending the questions to Diane, who can answer those questions for us. But I'd like to take a moment to say to everyone who is on the call, this is our call to action. We have to be the ones to go out and make our voices heard. And if you really believe that we should be helping so that we can be heard, I would encourage you simply join NAIFA. NAIFA is well established, has a whole operation engine influence in this whole process, as you could see from Diane's presentation. So that's on us to join, to make sure that we get involved both on the local, the state, and of course on the national level. So Diane, I would like to thank you very much for your time, for your insight, and we'll be sure to be in contact with those people that did send in their questions. At this point, we are going to take a 3-minute break or so, because we have got to anticipate, as today is Veterans Day, that we need to know more about vets benefits and how they interplay with Medicare. Why? It's another conversational starter for us. It's another way for us to reach out, to broaden our abilities to talk about extended and long-term care. So grab your coffee or your water, or just stand up and stretch for a minute, because the next presentation with Dan Mangus is going to be outstanding. Thanks. Hello, well, I hope you have had a minute to take a sip of water, get your pens and pencils ready again. And obviously, if you're lucky enough, you can be just typing notes right into your computers. I have to introduce a wonderful, wonderful man and a very knowledgeable speaker, Dan Mangus. He is the Vice President of Sales at Senior Marketing Specialists and has been in the business for a very long time. Please visit his bio on lecp.naifa.org/impact to see the full story. So with no further ado, I give you Dan Mangus. Dan? Well, today's
I will try to get everything working here for you. I'll share my screen here real quickly.
Okay. Let me just say that considering it's Veterans Day, we are very interested in this session. Here we go. Thanks, Dan.
All right. Well, it is a privilege and a pleasure to be here. I've had an opportunity to work with Carol and NAIFA for many, many years, and have been in this business now for about 38 years. It doesn't seem possible, but anyway, but I think something that Diane mentioned is probably top of my mind, is that the pandemic is a reminder that individuals need us right now. They need advisors for comfort and direction. And as we look at the individuals that we're working with, a lot of people are touched by Medicare, whether from a caregiving status or eligibility themselves. And a large part of the retiring population going on to Medicare are veterans. So we're going to take a few minutes, obviously in 30 minutes, we're not going to take a deep dive into a lot of different veterans type benefits, but we are going to take a high level view of some of those benefits and topics. And I'll show some resources where you can do a deeper dive for your research. I also am going to make sure that you have, all you have to do is send me a request, and I'll share both the slides and additional research links. There's 50 or 60 deep dive research links that I think you might find helpful. But before we dive into that, I thought I'd share real quickly, since I do work with Medicare, a few things that were just recently announced. One of them was an update on the new Medicare numbers. The Medicare Part A deductible this year is $1,408. That's going to $1,484. The Part B premium is going from $144.60 to $148.50. And the Part B deductible is going from $198 to $203. And if you want to look at this, at all of those numbers online, you can go to medicare.gov under costs at a glance, and you'll be able to see those numbers outlined for you. One notable thing as advisors that I think you might find helpful too to know is the impact in 2021 on IRMA, or the income related monthly adjustment amounts for Medicare. About 5% of Medicare beneficiaries are actually impacted by IRMA, where they have to pay more, obviously, for their drug plan and their Medicare Part B. But those adjustments range from, like with Part B, from $59.40 up to $356.40. So there's a big range. But IRMA became inflation adjusted in 2020. So individuals on the low income side of the IRMA brackets, because they're set, they're not percentages, they're set dollar amounts, could see a decrease in their IRMA payments. So like, for instance, if somebody is making $88,000 in 2020, the Part D IRMA is an extra $12.20 for their drug plan. And the Part B is $57.80. But in 2021, if they're still making that same $88,000, that will go to zero, because it's now that number has been inflation related. So they would not have the 1220 or the 5780 on top of that. So if you see some individuals come to you and they're having some of these adjustments happening, that's probably why you're seeing that. So I just thought I'd mention that real quickly to you. If there is one major takeaway that I think I would like to share today, is getting these questions on the table. There's been discussion all morning about ways of things that you need to bring up and things that need to be aware of and educating yourself on. But are you a veteran? If you integrate that into your fact-finding interview, I think you're going to find some interesting conversations. And the key will be to take that answer and then do something with it. Find ways that you might be able to help them to build something that is much more valuable for them, and integrate that, because you don't want to build a plan oblivious to some other types of benefits that may enter the picture somewhere down the road. So if they say, yes, I am a veteran, that actually gets you down the right direction, but it certainly doesn't tell you the type of benefits that they have. So we're going to examine some follow-up questions that might help you to better build a response to that input. From a statistical standpoint, I thought I'd share some of these just for you to kind of consider what of your clients may be veterans and what are the likelihood of that. It's important to note, though, that the largest living contingent served during the Vietnam War, which is now all retirement age. Almost all of them are retirement age, depending on what ages they served. But they're probably going to be somewhere between 67 up that those individuals served. And there's several reasons why that becomes important. But because of that, statistically, about half of all veterans now are 65 or older. Pretty interesting fact. And if you'll notice those stats at the bottom, if you're talking to a man that is from 65 to 74, there's a 34% chance that person was a veteran. If you're talking to someone 75 and older, there's a 47% chance. So you're going to run into that. And it's also important to note that these benefits and the eligibility for them can deeply impact widows and widowers of the individuals that were veterans. And so you want to look for any ways that you might be able to help. And when it comes to many long-term care issues, sometimes these widows will have benefits coming to them that they just simply don't even realize that they have at all. So if you ask, are you a veteran? And they say, I served in the military, but I did not retire with TRICARE for life, which, by the way, retiring is normally 20 years of service or more. And then they're likely to be eligible for TRICARE for Life. But if they didn't serve that long, they just served in the military, then they're a veteran, but they're not a retired veteran. So the benefits that they would receive are going to come primarily from the VA, or the Veterans Administration. And in order to get those types of benefits, you have to be eligible for those benefits in order to go to either the VA facilities or VA providers. And they're really expanding, by the way, the VA providers a lot into the community. There's a lot of those that the VA has now, but you have to see if you're going to be eligible. So here's what they start looking at. They start looking at 4 main areas before a person can access their VA benefits. Now, unless they had a dishonorable discharge, they're probably going to be eligible for the VA benefits. But as we talk about this today, I think it's going to be interesting for you to note that eligibility does not mean access. So they may be eligible for things, but that doesn't mean that they can necessarily get in there and use it, especially when it comes to some of the healthcare and accessing healthcare, which we've seen on all fronts right now because of the pandemic. Individuals can't necessarily get some of the care that they need, but it's very true when it comes to the veterans programs. So they're going to look at their disability rating. I'll talk a little bit about what some of those disability ratings are and how you might be able to help as an advisor with some of that. Their service history becomes extremely important. There's been a lot of expanded benefits available to people, especially around Agent Orange with all of the different types of exposure. So what's their service history like? Where did they serve? But the length of time, et cetera, and how they were discharged becomes important on eligibility. Then they go into medical need. How disabled are they? Were they disabled because of something that happened in the service, or did that complicate it, or were they just disabled because of some kind of a health condition? And then the last, of course, is income. But it does open up a variety of benefits. As you can see at the bottom of the slide, it's not just healthcare. VA is involved in a lot of different areas. But it is important to note, though, as we move through some of these discussions, VA benefits and using VA facilities is primarily for individuals who served but did not retire with TRICARE for Life. And I'll kind of express why that is important. Of course, if it's service-related injury, using a VA facility, even for people who retired from the military, is important. But we'll go into some of that in just a little bit. But there's also a lot of reasons, as we're looking at this, to look at options with Medicare and how Medicare is actually delivered for individuals who have VA benefits. One thing I might note is that if you're utilizing the VA, you don't necessarily have to have, and that's all you ever use, you don't necessarily have to have enrolled into Medicare because Medicare can't even bill in a government facility. And so they wouldn't necessarily have to have Medicare. So a lot of times people who have VA don't go ahead and enroll in their Medicare Part B. That's fine, except for the fact that if they ever want to get into Medicare Part B later, then they more than likely are going to receive some pretty sizable penalties for late enrollment and some delayed timing as to when they will actually be able to go into Medicare Part B. So it's a very important consideration to, are you going to use VA, stay there? If that's all you're going to ever use, that's fine. But if you're not, then you definitely need to be enrolled into Medicare. Here's some of the services that they provide. Obviously, VA hospitals are going to give inpatient care, and they really are focused a lot on preventive right now. There's a lot of activities around that. I would recommend all of you to be very conscious of the fact that because of the pandemic, preventive activities for individuals has gone down substantially. And it's extremely important for all of us to encourage our families and everyone else to stay on top of the preventive things that they're doing and not just postpone those, because that can obviously complicate situations later. The second thing mentioned is prescriptions written. That's probably one of the biggest areas that we see individuals try to involve Medicare because they want to use Medicare Part D for their drug plan. And the reason that they do that is because they want to be able to go to a pharmacy that's not in the VA, and they don't want to necessarily go to the doctor to have that at the VA to have that approved. And so they'll use an outside prescription drug plan. But veterans coverage or VA coverage for prescription drugs is credible coverage. So if a person does delay Medicare Part D enrollment until later, they won't incur a penalty because that was credible coverage. The copays right now, at least in 2020, for medications are Tier 1 is $5, Tier 2 is non-preferred generic is $8, and then name brands is $11. So if anybody is kind of comparing, should I purchase this plan or should I purchase that? Access to those pharmacies, cost of each one of them all have to be looked at, to determine whether that's a good call for you or not. But then they provide a lot of other services for individuals that they can access. This is also an area, by the way, where Medicare supplements and Medicare Advantage plans come into play. Having other health coverage is not going to hurt your utilizing VA services because they're going to be two totally different animals. So if you have a Medicare Advantage plan, it won't impact your eligibility to utilize the VA and the VA facilities and hospitals and things. But a lot of times individuals will elect Medicare Advantage is very common because Medicare Advantage, many of them have zero premium. And so a person can add that benefit to themselves without impacting their VA. And then it gives them an option for outside services. And it also, on most of those, give you a drug plan as well if it's an MAPD. So it is something that you can start looking at as to, okay, what they're a veteran, they didn't necessarily retire with TRICARE for Life, but they use VA facilities. How much do they use them? How much do they want to use them? And where does that come into play? Now, ability to use those is an entirely different animal, and you have to look at then priority groups. And there's 8 priority groups that individuals can be placed into. And those 8 groups, the link at the bottom will give you a complete outline of what those 8 priority groups are, but you can move up and down those priority groups. And one of the ways that you can move up and down it is percent of disability. And there's a lot of different types of things that can be considered disabilities. One of the ones I've seen that helps people a lot is hearing. Sometimes if their hearing has changed over the last few years, their priority group may have changed. And the higher priority group you are, the more likely you are to be able to actually go into and even get care at that facility. You may have full access to all the VA benefits, completely eligible, but with your priority group, if you're not in the high enough priority group, you're not going to get in, or the appointment's going to take forever for you to be able to get into that facility. So it's a lot to consider whether or not you want to go ahead and just use that as your only health care. It's fine, but you have to look at what your access is. But to kind of give it a little bit of a context, priority group 1 are individuals who have a service-connected disability that is 50% or more disabling, service-connected disability that makes you unable to work, or if you receive the Medal of Honor. Those are ones that put you in priority group 1. Also, many mental health issues will move you up to a priority 1 category as well. And so then it kind of starts to move down by the percent that you're disabled, all the way down to a 0% disability rating, which can be a little bit confusing, but it's basically you have a health condition, but it's not a compensatable service-connected disability. And so you can actually have a 0 disability rating. But as advisors, you want to really encourage them to go to their service officers regularly and make sure that they see if their priority group has changed or not. Because just natural with aging, a lot of times individuals will change a priority group just because their health starts to change because of different things that are natural as we get older. I'm starting to realize that more and more every day personally. But one thing I just mentioned, I just touched on, I really want to reiterate is utilizing their VSO or their Veteran Service Officer. I would recommend if you have any clients that are veterans that they see a Veteran Service Officer every 18 months or so, maybe even less, because as individuals' health changes, then some of these access to care and the benefits that they have change. But also laws continually change. Something that may have completely knocked them out of benefits may not even be applied now. And most veterans that I've worked with, it's been many years since they saw a VSO. And so it's definitely time for them to, to do it on a regular basis. The next area, I included this website. You might want to make a note of this. It is critical to take a look at how long-term care services are handled by the VA, because long-term care is not covered by Medicare. So some recovery care benefits are in the picture and things like that, but actual long-term care is not. And so you do want to look at services that the VA provides. However, sometimes there can be a long wait. Like for instance, right now, the average wait time is in the neighborhood of about 18 months in order to get into a state veteran facility. And even when they get in, they're more than likely going to have co-pays and cost share. So just if they say, well, I can use the VA nursing facility, that does not mean that they don't need your services for planning or programs that you have to offer, because you want to be able to give them that access and cover any expenses that they might incur. In relation to some of these skilled nursing services, I'll go into how that impacts with TRICARE for Life. But like I said, I'd love to take a deep dive into some of this. I'll make sure I get you the resources, but in 30 minutes, it's just kind of impossible. But I just want to give a nice big overview of what veterans programs are like. VA resources. There is something called a VA welcome kit. It is actually misnamed. VA welcome kit is great for people that are just going on to those services, but it's wonderful for anybody that's been in no matter how long. It's a great reminder. It's a great tool to use. It has tons of contact information in it, tons of the details for people to look up, because if there is one thing that is true, when you're dealing with a veteran, everybody's circumstances is so unique. Where they served, how long they served, when they were dismissed, where they live, what their incomes are. All of these kind of things are so different that you cannot say blanket statements. Yes, you're covered for this, or no, you're not. There's always the exceptions to those rules, but the welcome kit will help you a lot. The other in how to apply for VA healthcare, that gives all the links, walkthroughs, forms, everything else that you need to know to do that. The link for VSOs shows you how to get to a veteran service officer and utilize their services in helping you out. Most of the time, their offices are going to be in a VA hospital. That's where I've seen them most of the time, but not all. And there's good VSOs and there's bad VSOs. I hate to say that way, but you need to make sure you try to get one that is really, truly trying to help you, and most of them are. Then there's the VA service-related issues that are important, and then Agent Orange exposure. Keep in mind that there were rainbow herbicides. Agent Orange was just named that because of the way the barrel looked that came in, but Agent Orange exposure continues on a regular basis to be expanded as to what that impacts. And it truly impacts so many different chronic conditions like diabetes and heart disease and all different kinds of things that can be tied back to Agent Orange exposure, that you probably will find benefits for some of your clients if they had any potential exposure to any of the herbicides and things that they used over in Vietnam or other locations. So those things can help tremendously with that. To give you kind of an exposure to that, with the Agent Orange, to expound on that real quickly, there was 19 million gallons of that sprayed on Vietnam. And I use Vietnam because so many of the retired people are Vietnam veterans. But there's Agent Blue, Agent Green, Agent Pink. But there is something called presumptive exposure. And that's what continues to get expanded. So if they're a brown water veteran, which means that they served in the waterways of Vietnam, if they're a blue water, which means that they were in the ships that were close to Vietnam, some of that used to have to prove exposure, but now there's much of that is presumptive. Or if they worked on C-123 planes, that could be stateside. That's the plane that hauled all that stuff. That could have been in Germany. A lot of them were based out of Germany. That could have been in the United States, or it could have been on an aircraft carrier, whatever. If they worked on or around C-123 planes, there's presumed exposure to that, and it opens up a lot of things, like if they've had prostate cancer or Parkinson's disease, things like that, type 2 diabetes, all of that is assumed to be presumptive from that exposure. So what if they say, I served in the military and retired with TRICARE for life? Well, that's kind of like saying I retired from a group. The group insurance for the military is TRICARE. And if they retire from that group, then it's TRICARE for life that they become eligible for. And that allows you to start looking a little bit different as to how you're going to make recommendations for that person because of that particular way that they have their coverage. So TRICARE for Life is managed by the Department of Defense. Medicare is managed by the Center of Medicare and Medicaid Services. But the interesting thing about TRICARE for Life, it's a Medicare wraparound program. And so that means that you have to have Medicare Part A and B, and then it layers on top of that. Very much like Medicaid would. If you're familiar with people who have Medicare and Medicaid, Medicare is the base, then Medicaid pays on top of it. It's the same way with TRICARE for Life. That's the reason why someone with TRICARE for Life can replace their original Medicare with Medicare Advantage. And this year, there was a gigantic step forward by most of the big carriers. United Healthcare, Aetna, Humana was already very involved in it, but a lot of them stepped up their program that is designed, MA only, is what they call a Medicare Advantage only plan, because those people with TRICARE for Life can just utilize that. And there's pros and cons. One pro is that you might add a bunch of ancillary benefits that you wouldn't necessarily have. A con is you're probably going to limit your network that you have to utilize for your plan. But again, TRICARE for Life does not mean that you don't need to touch it, but it does mean that you need to be very, very careful with how you deal with that, because medications are the big thing. I personally recommend never trying to replace the drug portion of TRICARE for Life. It gets extremely messy, and it's all administered through Express Scripts, but it does get messy if you try to do that. The DEAR system, the Defense Enrollment Reporting System, if you're meeting with somebody that's 65 or turning 65, this is a great thing to do with them, is help them to get everything set up in the DEAR system, because if it's not accurate in there, you don't get the benefits for it. Like I mentioned before, TRICARE for Life is a Medicare wraparound program. If Medicare doesn't cover something, then TRICARE for Life will step in. Like, for instance, care overseas and things like that. TRICARE is going to be primary, Medicare secondary. But if it's something that Medicare covers, then they're going to be primary. And there are some things that Medicare covers that TRICARE doesn't. An example of that is like chiropractic care. So there's going to be several of those things that you want to take a look at. If you want to see who pays what and when, this publication, Who Pays First, from Medicare, is a wonderful tool as an advisor to see who's going to be involved in this bill. So if you have any kind of billing, if you're working with some of the family and they're trying to figure that out, it can get confusing for even the providers. And so sometimes things get a little bit confused with that. But in the interest of time, which is quickly fleeting me, you probably just need to reference those types of documents in order to get that piece of information. Some more links for you there, more resources. The TRICARE for Life handbook. If you do nothing else with TRICARE, just get that booklet, have a link to it on your desktop. And if somebody brings that up, get the TRICARE for Life handbook. It's probably going to answer most of the questions. And then they have some other specifics. If you go to that website right there that I have listed, and again, you'll probably need to get a copy of the slides because we're moving pretty quickly here. But on the right-hand side of that website down on the bottom right, you'll find the link to download that. They update it every February. So they'll be updated again at the beginning of the year, but right now it's the one that's updated from February. Aid and attendance. I know Carol's an expert on aid and attendance, but essentially what you have with aid and attendance is an opportunity to increase their pension to help to pay for some of the long-term care that they have. Aid and attendance is probably one of the most abused online programs in relation to veterans. So you want to make very certain when you're looking up information on aid and attendance that you're very careful that you're looking at actual veteran information from veteran services, not a commercial site. I'm not saying that all the commercial sites are bad, because some of them are not at all, but there are some that are. I saw one the other day that charged somebody $7,000 for something that they could have done easily online with a couple forms. But anyway, aid and attendance, definitely look into that. It's a tremendous opportunity for individuals to get some assistance with. And then there's one last area. If you've not followed any of this, please do so. It's the PCAFC. It was basically something that was in place to pay the family to help care for somebody who was a post 9/11 individual who had service-related injuries. But they're decreasing those requirements to where it doesn't have to be service-related, and they're continuing to ease this coming year. And again in 2022, they're going to increase again the age level. So a large number of your clients are going to be able to get additional funds to help pay the family to care for individuals with a serious health condition. And they're taking away the fact that it had to be service related. So this is an area that will impact your practice. Become familiar with it. You're going to see it this coming year, but you're going to see it a lot more even the next year after that. A primary area when programming individuals for long-term care. All right, it looks like I am completely out of time. And so this is my contact information. I'm extremely open to any kind of questions that you might have, any scenarios, anything I can help with. We're all in this together. Drop me an email and I'll make sure I address any questions that you might have.
Thank you so much, Dan. You are such a wealth of information. It's always so amazing to me. No matter what topic I approach Dan with, I get tons of information, but especially you'll notice Dan offered us a lot of links. And let me tell you that anyone who was putting on the chat any questions or wanting to reach out to Dan, if you, for some reason, don't have the ability to send a quick email to the address on your screen, we will be letting Dan know about the questions, and I'm sure he will have himself or someone from his team contact you. Really outstanding. Well, I see that we have 1 minute or so before our next speaker. So I think at this point, perhaps we'll just thank Dan, take 30 seconds, and actually I think it will be better if we just move right into our next speaker. Actually, the topic for the next presentation is wellness initiatives. And we heard during several of the panel discussions, both yesterday and today, that wellness is becoming top of mind. And I'm sure, like me, you've read a great deal about consumers feeling that wellness is top of their mind. If COVID did nothing else, it really reminded everybody that there are effects of needing to take care of ourselves and do the right thing. Well, here's the question though. What if the insurer wants to add something on wellness to their product so that, again, another topic to talk about, just as we're encouraging you to ask, is your client a vet? Perhaps they're dealing with their parent who is a vet. It gives you a conversation opener. Well, our next speaker is Sandra Jones from, and I have to read this because I always mess up the name, Sandra is with the law firm we're all very familiar with, Fagra, Drinker, Biddle, and Reith. Try saying that fast 3 times. At any rate, we'd like to very much welcome Sandy, as I call her, Sandra Jones, to talk to us about what kind of hurdles a insurer has to go through if there are aspects of well care that they would like to add to their product offering. So can we have Sandra join us? Sandra?
Does anyone see me, or can you hear me?
Are. Welcome,
Oh,
welcome.
Welcome. Thank you so much, Carol, for that kind introduction. And my law firm is certainly a mouthful. It's Faegre, but we used to be Drinker, Biddle, and Reith, and we merged in February and became Faegre, Drinker, Biddle, and Reith with the firm Faegre, Baker, Daniels. It is quite a mouthful and not really a fun word. I remember when I heard we were merging, I was not that thrilled, but here we are. Again, thank you to everyone who's presented so far. I found all of these presentations really, really interesting, and I hope that my presentation will play into it well. I'm going to start sharing my screen too. Okay. Hopefully we're all right there. And all right. So as oops. Okay, so as Carol had noted, I'm talking about wellness initiatives and LTC insurance keeping people home longer. And as Carol also, already noted, wellness initiatives are really something that I think is impacting our entire society. And other lines of insurance have already started contemplating wellness initiatives and building them into their products or offerings that they make to their insureds or potential insureds. But long-term care, for whatever reason, has been slow on the uptake to incorporate InsurTech or wellness initiatives into their products. And there are several reasons why, which I'll get to, but it really does seem as though the trend is moving towards wellness for long-term care insureds and elderly folks in general. I actually just attended yesterday a Society of Actuaries Long-Term Care Insurance InsurTech virtual conference. And so I have a lot of good information I'm going to try and share from that conference that ties nicely into this. But the point of raising that is really to show that the entire long-term care insurance industry is starting to think about wellness and wellness initiatives and how to keep folks in their home longer. The trend really is towards staying home. I'm sure most of you who have elderly folks in your lives or have helped a parent or grandparent as they age, you've realized that in an ideal world, if they could, the elderly people in your lives would much rather stay home. Studies have shown that people who live in their homes longer remain happier. They are in their comfort zone, so to speak. You are close to your family, you're less lonely, you get to feel independent, you have familiarity with your surroundings, and again, you're able to keep things that you're used to having, right? Like your own things at home stay with you as opposed to having to get rid of them. And studies have also shown that when seniors are happier, they stay healthy longer, which means they're less likely to be on claim for insurance because they are healthy. They're not necessarily needing insurance benefits to kick in. We've all figured out that in the long-term care insurance industry, that providing care in the home is more cost-effective than providing care in a facility, right? Facilities are getting more and more expensive as time goes on. Rates are going up consistently. Having somebody come into the home or caring for your loved one in the home yourself has become a lot more cost effective. And so companies are really trying to figure out how they can keep people in their homes, how they can accommodate for care in homes, and how technology can assist them in doing so. I added this slide, which all of us are fairly familiar with. I won't even say it's from June actually of 2020, this chart, but the impact is still made all the same. Right, so we're looking at the number of hospitalizations per 100,000 people And folks that are above 85, of course, make up the highest rate of hospitalizations from COVID. And so I'm a long-term care insurance lawyer. I probably should have said that initially. And while I focus a great deal of my practice on litigation, I also focus on regulatory issues and helping long-term care insurance companies and their affiliates figure out how best to serve their insureds and avoid potential issues, pitfalls, and the like. And COVID has brought a new set of that into the long-term care insurance world, tying in really to what I just said, which is that people want to stay home. People who are in facilities are scared to go into facilities, and facilities have really changed in terms of keeping people safe. One of the things we were talking about at the Society of Actuaries conference is how folks who are living in facilities right now, in order to avoid outbreaks within the facilities, are being confined to their rooms. When they used to be able to go to the dining hall and eat with their friends, they're now having to eat by themselves. Classes and exercise regimens are being canceled. You know, if the facility had pools or recreational facilities, those are now closed to stop the spread of COVID. And this is causing not only a decline in terms of safety, but also in terms of happiness of the folks who are living in the assisted living and nursing homes for which the restrictions are being placed. And so it truly is that the trend of staying home seems to be the future. Again, I think we all know very well that standalone long-term care insurance is intended to protect against pretty much, you know, physical or cognitive impairment that impacts someone's daily life on an ongoing basis that's chronic in nature. And otherwise, in other words, and I hate to read off the slide, but the best way to put it is it's expected to last for a substantial period of time. Most contracts have a 90-day waiting period at least that has to be satisfied before benefits kick in. And so these are truly, you know, folks that are ill. Alzheimer's disease, dementia are on the rise. We're starting to see more cognitive decline and more long-term care insurance claims filed for those who are cognitively impaired, as even opposed to those who are physically impaired. And those claims are always harder to administer, and they're also harder to, basically those people will remain on claim forever. They're not really going to heal from their Alzheimer's or dementia. And so finding ways to prevent Alzheimer's disease, dementia, and cognitive decline is always in the best interest of both the insured and the insurer. And so it's something that the industry should really start to encourage. As I mentioned previously, the insurance market has been trying to find ways to adapt to these trends and the desires to stay home, but it's been a little bit slow in terms of long-term care. Long-term care has not typically employed wellness methods and technology to help its insureds or to provide its insurers extra benefits. And so as we move into the future, I really think the push towards insure tech and the like are really going to help make long-term care insurance, number one, more attractive for insureds, because if it offers some sort of benefit or pre-benefit rather, before you have to go on physical claim, folks are going to be more likely to purchase it. And then it's also going to be more financially viable for insurers. I heard earlier, you know, wave 1 and wave 2, obviously phase 1 or wave 1 of standalone long-term care insurance has had its issues. And so as we move into the future and try and solve the issues related to the long-term care problems in our country, hopefully coming up with products that are able to provide wellness initiatives and ways to keep people healthier longer are a part of that product development. This is just some of the ways I think that companies have started to already break through using or rather using wellness initiatives to help their insureds or potential insureds, including meal prep, home modification services, management of their medications, socialization planning, caregiver support, technological monitoring, emergency alerts, and of course now in-person and virtual care delivery, including telehealth visits and whatnot. And of course, many of these ideas are very early on. I think we're going to, again, start to hear more from insurance companies as to efforts that they would like to make to improve their services that they can provide to insureds or potential insureds to which agents are selling. So elder tech is really a brand new industry within and of itself, and it's taking off big time. I've included a couple of options I guess companies here, not options, that have entered the elder care and elder tech market. But for instance, I say predictive analytics. We recently learned of a company that uses like neuro tracking by using an iPhone to help determine whether or not somebody is in the early onset stages of Alzheimer's or dementia, or whether there might be another reason for their cognitive decline. Using other types of analytics that come out of simple devices like, I'm sure that some of you have heard that life insurance companies, for instance, are giving Apple Watches or Fitbits to their insureds in order to track their health and their activities and their heart rate and whatnot. Those are all ways to, of course, help determine, how healthy someone is really being, and are they as active as they claim they're going to be, and does that person potentially deserve some sort of discount or whatnot. And so predictive analytics is certainly on the rise. In-home smart technology, though, is huge. But here I've noted CareValidate and K4 Connect, but yesterday I learned of a new company that discusses it's a green home for, it's a new type of facility or facility modification that creates a happy space out of an assisted living facility. In other words, it makes it something that anyone would want to live in, right? It's an open concept living with lots of natural light. It has patios and doors to be outside. It has ways to connect with your neighbors, activities outdoors, things that are certainly geared towards keeping folks happy and giving them that in-home focus and opportunity. So CareValidate has something that's like a smart light bulb that tracks who's in the home, and it helps track activity data to identify whether or not somebody's care needs are changing. I think that's certainly very cool. There are robotics and artificial intelligence. We could have a whole entire discussion on artificial intelligence and how that's helping folks to stay in their home. There are robots that communicate with or act sort of as a portal for seniors who are confined to their home, so that they feel as though they have the same social interaction as though they were outside of the home. It brings in classes and friends, and for folks who are really sick and can't travel, it allows them to communicate with their family members and grandchildren and friends all through this portal that is on wheels and follows them around and accommodates them. There's also artificial intelligence that's being able to physically lift or care for people. It's being developed. I know that there are robotics that help people physically, but some of these robotics and artificial intelligence devices are really starting to be geared towards providing care themselves. So now to the hurdles, right? So we're all probably wondering, why has the long-term care insurance industry and the insurance companies, why have they not adopted these, right? It seems as though they're a win-win for everybody, especially, right, we figured out the win-wins are you keep someone in their home longer so they're happier. You can provide them with healthy living options, and so they are able to sustain their health longer. You can provide them with resources to remain off, basically, incentives to remain off of claim, keeping them happier and healthier longer. But at the same time, that means less claims for long-term care insurers to have to pay. So why then has the win-win not happened? So in long-term care insurance, there are two specific hurdles. The first one involves rebating, and the second involves the tax qualified status of most of the standalone long-term care insurance policies under 7702B of the IRC. So first, with regard to rebating, most state laws and regulations have anti-rebating laws. And rebating is seen as an inducement for an insured to obtain or maintain coverage. So the focus on obtain or maintain is important, right? Because in theory, you don't want to use rebating, or something can be seen as rebating if it's an inducement to purchase the policy, or seen as a rebate or a give back. But when somebody's paying ongoing premium for something, giving them a benefit like a wellness benefit can also be seen as rebating for their ongoing premium. In other words, they're paying premium for future, for the potential of going on claim in the future. And if you're providing them a benefit under the policy early before they're benefit eligible, that could be seen as rebating in a regulatory scheme. And so even though the wellness programs have great value, there's a risk that many of the regulators who are not yet as fluent in long-term care insurance as others are, and I really do think that they're coming along, because you know, we've heard throughout the day so far and yesterday that long-term care, not necessarily long-term care insurance, is an American problem. It's a problem or an issue, I should say, that all of Americans deal with at some point or another in their life, whether it's for themselves or, again, their family members, friends, or other loved ones. You're going to be dealing with the issue of someone needing long-term care and how to accommodate that. We've discussed, again, the standalone market and how that's not been as profitable as an endeavor for many insurance companies, and the regulators have their own issues with standalone long-term care insurance. And so as we develop new programs and policies and hybrid products and you know, provide riders for long-term care insurance, we think of regulators are starting to recognize the value of what long-term care insurance can bring. And so our hope is that anti-rebating provisions that most of the states have will soon be getting an overhaul. Specifically, the National Council of Insurance Legislators, NCIL, has adopted, and also that NAIC is in the process of adopting, changes to their Model Act anti-rebating laws that will contemplate insurers being able to have access to wellness programs and to provide those to their insureds early on once insurance policies are purchased. The benefit eligibility component, or how you're to receive the wellness initiatives, I think is still very much up in the air, but the idea is that insurance companies won't face the fear of regulatory scrutiny or punishment if they start to provide these sorts of wellness initiatives to their insureds before someone is benefit eligible. So 7702B is perhaps the larger hurdle to rebating. And as most of you know, 7702B is what gives long-term care insurance its tax qualified status. I'll talk in a minute about non-tax qualified policies and how this might not apply to them, obviously. And that might potentially even be a somewhat of a loophole, if you will, to allow companies who have non-tax qualified policies to issue benefits to their insureds prior to benefit eligibility. But the benefit of 7702B is, again, tax qualified status, which means that the benefits that the insured will receive are tax-free to them. And so in order to keep the tax qualified status, 7702B sets forth fairly stringent terms for all long-term care insurance policies to contain. The biggest, of course, being the chronic illness component, right? An insured must be chronically ill in order to get coverage or benefit under a long-term care insurance policy that's tax qualified. Chronic illness is defined as two different things. The first is that the insured must require substantial assistance with 2 or more of their activities of daily living, or they require substantial supervision to help them with due to a severe cognitive impairment. So in other words, there's only 2 ways to be chronically ill, albeit one is physical and one is mental, and those are really the only 2 ways, I suppose, one could be chronically ill. But at the same time, there are pretty strict standards for that, right? And as a long-term care insurance lawyer focusing on litigation, I see where those issues arise on a daily basis. In other words, folks who are not truly chronically ill, but are residing in facilities or otherwise might be paying for care of some kind, are not actually benefit eligible under 7702B. And so while 7702B sought to add clarification to tax qualified long-term care insurance policies when it was enacted, it's actually added some complications given, first of all, the language of substantial in terms of substantial supervision or substantial assistance, and what does substantial mean in terms of providing those types of assistance. But in conjunction with today's topic, 7702B essentially prevents companies from providing any sort of benefit to an insured before they are chronically ill. So in terms of wellness programs, if we're trying to keep folks healthier and to allow them to remain in their homes and giving them something to do so, right? Whether that be, like I said previously, a meal service or a gym membership or a discount if they have a gym membership, or a Fitbit, or gosh, I think we could go on and on as to what some of these wellness initiatives might be to encourage healthy eating and healthy being to stop people from needing to be on claim. Technically, those offerings could be in violation of 7702B and could jeopardize the tax qualified status of the policy, as well as potentially getting the insurance companies in trouble. And I think that this has really been one of the biggest hurdles, because most standalone long-term care insurance policies are tax qualified, or have been since the inception of 7702B. And because of that, companies have been shy to offer wellness initiatives or other benefits before someone is benefit eligible. We've seen this in the context, especially of home modifications, where folks who are potentially wheelchair bound or recently wheelchair bound have sought home modifications for their current homes to help accommodate them. And if they are not truly chronically ill, insurance companies are not able to provide those benefits. And in some ways that's a shame, right? If an insurance company could spend maybe $10,000 and provide the benefit to the insured to allow them to stay in their home and do so safely, they could avoid that person having falls, getting depressed, getting sicker, and instead, will pay less for that home modification than they will claims in the future. But currently they're essentially stopped from doing so. The bright side, though, is that the Department of Treasury, of which obviously the IRS reports to and is a part, has recognized this issue, which is a first step, right? And fantastic, frankly. And just in this past August, the Treasury released a report from the Interagency Task Force for Long-Term Care Insurance, and I linked to that here in my slides, and I'm happy to provide it to anyone. But the crux of it is that the task force endorsed the idea of programs aimed at enhancing the ability of those potentially needing LTC to remain in their homes, right? So that's huge. The federal government obviously recognizes the trend that people want to stay in their homes and the issues with long-term care insurance and 7702B. And so, again, this is an encouragement to lawmakers to go ahead and facilitate changes that might allow these types of incidental benefits, quote unquote, or wellness initiatives to fruition, and to think about how private insurance coverage for long-term care expenses should really be paid and how it should be structured. And maybe long-term care is not to pay for care that occurs once it's too late, but rather to be a preventative type of care. So this we've covered a lot of this, and I'm again trying to be mindful of time. I think I have 5 more minutes or so, but wellness programs and pre-claim intervention are going to be a significant part of the long-term care, and not just insurance, but long-term care conversation for years to come. I think we're just scratching the surface of wellness initiatives, elder tech, and how this is all going to come into play. I know, I'm sure there are companies from which representatives are attending today that have already started to think about this too, and how they might incorporate it into their policies and how they might be able to go outside the 4 corners of the policy to provide wellness initiatives to their insureds and potential insureds. And I think the important takeaway is that despite the 2 hurdles that I talked about, which are currently preventing this from becoming mainstream, the regulatory community at both the state and federal level are recognizing the value in keeping people home, recognizing the value in maintaining a healthy society, and have also, of course, recognized that there's great value to wellness programs and InsurTech, and beginning to take those steps necessary to allow the insurance company, the private sector, to embrace them more widely, make them a bigger part of of the products that they create and sell, and provide those benefits to their insureds without worry of being slapped down. That was the end of my presentation itself. I wanted to leave time for questions, but Carol, I don't know. I plan to leave about 5 minutes for questions, but I'm realizing that's probably not what we're doing.
We're okay, frankly, and we do have lots of questions. So let me throw out a couple of them because they've come in hot and heavy.
Oh, good.
Yeah. The first one, of course, deals with that very question of, well, if Apple can do it and all of these others can do it, are we hearing that we can't do the very same thing that Fitbit and Apple? Because I know for some of them, they have ongoing charges. That's how they keep you engaged in what they do. So
Right.
why is this different for long-term care?
So it really is for the main concern, I think, well, I should say, as a matter of course, and I mean this with all due respect and with no snarky tone to this, insurance companies tend to be fairly conservative in terms of what they're willing to do because they don't want to face regulatory scrutiny or potential litigation or issues related to the IRS, right? They want to be as compliant with the policies and the regulatory procedures as possible. As a litigator and regulatory lawyer, I mean, if I could even tell you how careful we are with regulations surrounding everything, and those of you who work for insurance companies or are certainly familiar with that. And so 7702B is what's added the complication for long-term care insurance, whereas other lines of insurance, for instance, I know John Hancock offers an Apple Watch to those who purchase its life insurance to offer discounts or incentives to keep premium lower because they are focused on your health. And if you meet certain health parameters from that, you're being rewarded. Again, long-term care insurance, I think, is worried about the rebating component, but most certainly that 7702B component of it, where any benefit that's given before chronic illness can be seen as a violation of the tax qualified status of the policy. But like I said, I hope that changes soon. And I really do think it's right on the horizon of doing so.
Well, let me also ask, somebody wrote, is it the same for the 101G, since that's a different area really and has a different approach to the insurances, and some of the hybrid products use the 101G instead of the 7702B. And I'm sorry if we're not indicating what those are, but
no, I know what that is. So that's a really good question. And actually, I did mean to address that before I stopped talking and just simply forgot. So I do think that the companies who use those other provisions should start thinking about wellness initiatives and incorporating those into their business models and thinking of where in pre-existing policies those benefits might fall and how they can be incorporated into their business. That's where I was going, I think, with the non-tax qualified policies as well. They're few and far between, but in standalone long-term care insurance, non-tax qualified policies might allow for these types of wellness initiatives to come into play much sooner in the depending on what they require for benefit eligibility.
so that kind of leads us to, I was thinking back to Denise Scott's session yesterday, where once the employer does say, okay, we're going to do a group long-term care, and as she mentioned, there's group hybrid as well as the traditional long-term care, that then they can use that 360 plan once it is sold. So obviously it still has to be after the fact.
Right.
Which, yeah, well, so do you expect to see more and more insurers developing product around this whole wellness idea?
You know, if I had to predict it, I really do. I've had conversations with a lot of insurance companies who have consulted with us, or for instance, you know, that Elder Tech SOA conference, the first one was last year. And coming out of that, we had a lot of conversations with insurance companies as to how they might be able to already start thinking about this stuff, and how they might incorporate it either, you know, prior to the sale of a product, but most certainly into their new products and selling their new products to their insureds. And I see that there's a question, right, that says like about whether or not this is an inducement. And I certainly think that's a consideration, right? As a lawyer, I'm always looking out for that type of thing, but I think it's all about how it's presented and what the true benefit you're getting is. I mean, if you're getting, I don't know, like if you're getting the Apple Watch and you're allowing a company to track your wellness, it's really your wellness that they're having access to. The Apple Watch is just simply a tool. And I also am not sure, candidly, and I'd have to look into this, whether the Apple Watch is a gift or whether it's a conditional gift, right? In other words, if you get the Apple Watch and you don't adhere to the wellness initiative, or do you have to give the Apple Watch back? I'm candidly, again, not entirely sure about that, but that might be a way actually of preventing inducement if the item is not an actual just give me, right? And it's instead a true tool to help people with wellness and staying healthy and staying out of claim, or off of claim, I should say.
Well, Sandra, this has been a really wonderful session. Again, LECP is just trying to broaden the entire world, talking about long-term care, extended care. And we thank you so much for bringing up InsurTech and other things. And speaking of that, I will start to close us out here with tomorrow's session. The first session actually is a session on technology. We're going to talk about how social media has helped these individuals grow their business, how it has helped them reach out to a different section or a sector or cohort, depending on what it is that they are using it for. So that should be a really interesting session. And of course, our own Ryan Penny will be leading that session. From there, I think we have to expect to see some more of our presenters. And I just want to mention, because I know it's the top of the hour, but I wanted to mention that tomorrow our wrap-up session is actually about us, about the survey that tells us some of the perceptions that we have as agents, advisors, and producers, why we're selling what we're selling, or actually why we're not selling what we're not selling. So I think that you're going to find that session is very much of interest to us. It is a preview. The survey is not complete, but we appreciate that we're going to get a preview. NAIFA was one of the sponsors of the program. So I think it's terrific that you were with us today, and we very much look forward to day 3 of the NAIFA Impact Week, Long-Term Care. Thank you so much, and have a good evening.